T-shirt.
Unfortunately, I just
That's your event, Encore Event Technologies, is that it? I don't.
Yeah.
Hello, everyone.
Hello.
Mark Brown, Chair elect of the Florida Bar Tax Section.
Here, you're not going to be.
Welcome to the Ullman Year in Review. And we have a room full of people for the first time in, I guess, about 2 years. Welcome back, everyone. This is the first time, actually, that we're doing this as a hybrid presentation. This is sort of a test run here. We have the people here in person, and we're also streaming this via Zoom. So we'll see how this goes. You know, it is a free CLE. Let us know the feedback on how this is working virtually. We definitely want to hear your input.
What do you want, Bill Coleman?
That's not going to Coleman's.
We're going to mute everyone who on Zoom for the entire program. The people who are here, who are attending live, they have a little bit of a benefit.
Copy?
If you want to ask a question and the speaker has time at the end of their presentation, they'll take questions. So we just don't want to unmute it, go to the Zoom calls, and we hear everyone's dog and all that kind of fun that we've all experienced for the last year and a half. We have free Wi-Fi in the room. I think it's conference Wi-Fi, and the password is Amelia19. So if you need to check anything while you're in the room, please do. 12 p.m., we have a new tradition we might be starting. We're gonna have mimosas here. So right before Michael Lampert speaks, we're all gonna, we'll see how this works for Michael. We're all gonna go out, get some mimosas and play a little ethics bingo, which is sure to be one of the highlights of the week. I do want to thank all of our sponsors. We were going to give sponsors a minute to talk if any of them are here in person. I don't know that I see any of the sponsors in the room, but we do want to recognize our sponsors. Actually, you know what? I think I see a sponsor back there. Wait, all the way in the back. He might be hiding. Mark Scott, you want to come up and say a word? All right. Kaufman Rossen, Mark Scott, longtime director, very active with the tax section, longtime sponsor. So I just wanted to thank him. He's here in person. So why don't we just start a little early, get right into our program. Our first speaker is Mike Wilson. Mike Wilson's a partner with Williams Parker in Sarasota. He's a transactional tax attorney, and he's certified as a tax specialist in tax law, and just a great leader. One of the things you should know, it's not even in his bio yet. This is hot off the presses. I believe he's now president of his firm, which is a great recognition. So Mike, why don't you come up and tell us a little bit about business taxes?
Thank you, Mark, for that kind introduction. And it is wonderful to be here and seeing people live and in person and see their smiling faces and not on a Zoom box. Again, Mike Wilson, and as Mark mentioned, I'm going to do an update on business entities, and I'm going to focus more on S corporations. Later today, Thomas Treece is going to give an update on tax partnerships. But jumping right into the materials in the program, first thing I wanted to focus on, of course, one of the big developments over the last year and a half was the Paycheck Protection Program under the CARES Act and some associated tax issues. I'm sure, as you all know, right, the general idea is taxpayer would get a PPP loan. They'd use those proceeds for what the CARES Act refers to as covered expenses, generally payroll expenses, rent and utilities. And then a key feature of it is that when the PPP loan would be forgiven, Congress specifically put a clause into the CARES Act that said that that would not be a taxable income event. Or of course, without that provision, if any loan is forgiven, generally you're going to have cancellation of indebtedness income. But Congress specifically, added this exception. And so one of the first issues that really came out of this was, well, okay, if the PPP loan is generally thought to be forgiven, are those covered expenses going to be deductible under Code Section 265? And for quick background, 265 is a pretty old tax provision that generally says it disallows expenses that are allocable to a class of wholly exempt taxable income. And it frequently applies where you incur deductible expenses to try to obtain tax exempt income. So a very common example would be legal fees incurred to secure tax exempt Social Security disability rights, for example. So there was a lot of tax commentators pontificating about whether 265 applied in this context or not. The IRS got in the game in Notice 2020-32, where they reasoned that forgiveness of PPP loans was a class of exempt income under 265, and therefore covered expenses were not going to be deductible. A lot of tax commentators vehemently disagreed with IRS on this. A lot of arguments around 265 and its applicability. I think the most interesting argument was sort of a statutory construction argument, which is that Congress went out of their way to say in the CARES Act that the cancellation of the PPP loan is not income. And that had to have some meaning. And if that wasn't in there, you'd have COI income, but then you could deduct the covered expenses, putting the taxpayer in sort of a neutral position. And so if you, by Congress adding this provision saying forgiveness of the loan is not taxable, but IRS then saying, well, no, 265 applies, and so you can't deduct it, you're putting that taxpayer back in the same tax provision, and in effect, giving no meaning to the provision that Congress put in there saying that the PPP loans would be forgiven. So while that controversy was going on, the next issue is, well, what happens if you got your PPP loan in 2020, you incurred a bunch of deductible expenses in 2020, but your loan wasn't forgiven in 2020. At the end of 2020, we had a lot of clients who had applied for forgiveness, but not yet had heard from their lenders in the SBA whether they were going to have forgiveness. So the IRS issued a revenue ruling 2020-27, where the service concluded that taxpayers could deduct could not deduct their covered expenses under their previous 265 analysis if there was a, quote, reasonable expectation that their PPP loans would eventually be forgiven. And they relied on some language in 265, which basically disallows deductions under 265 if there's a reasonable expectation of reimbursement of those expenses at the time they're paid. And of course, the problem with that is what the heck does reasonable expectation mean? Especially as you'll recall, after the PPP program came out and taxpayers, our clients, got these loans, very quickly you had the SBA issue out a lot of rules that were very confusing, frankly raised more questions than they answered. Some accusations of maybe moving the goalposts, especially around, you'll recall, the good faith certification.
Yes.
Did these taxpayers really need the loans? Were they really?
I just wanted.
A lot of controversy about that sort of last summer, last fall. Thankfully, earlier this year, Congress sort of quashed all of this controversy in the Taxpayer Certainty and Disaster Tax Relief Act of 2020 provides in relevant part that no deduction shall be denied, tax attribution should be reduced, basis increase will be denied by reason of the exclusion from the gross income of the forgiveness of a PPP loan. That legislation is retroactive, as if it was the original CARES Act, and so IRS then accordingly declared obsolete its prior rulings on that issue. Also, what that subsequent legislation provides is that forgiven PPP loans are treated like tax-exempt income, in that if you're a shareholder or if you're an S corporation or a tax partnership that had the forgiven PPP loan, you get an outside basis increase as a result of that tax-exempt income. And then finally, the last point I'll make on PPP is you now have, because of IRS guidance and the subsequent legislation, you have taxpayers in the position where they got a PPP.
Well, that's what I thought.
They incurred covered expenses in 2020. Based upon the IRS guidance, they didn't deduct those expenses in 2020, but then subsequently this legislation in 2021.
I have no problem in
So these taxpayers now have to go back and amend their 2020 tax returns to deduct the covered expenses. Fortunately, IRS came out with a Rev Proc 2021-20, provides a safe harbor that's fairly easy for taxpayers to meet, where you have the flexibility to deduct those covered expenses on their 2021 tax returns instead of having to go back and amend their 2020 tax returns. Okay, leaving PPP, wanted to hit a couple of a smattering of interesting items. One is the Deckard case, which was an interesting tax court case that came out last fall. Stands for what seems like an obvious proposition, which is that a not-for-profit corporation is not an S corporation. The primary issue in that case was whether an individual taxpayer was an S corporation shareholder of a Kentucky not-for-profit corporation. The facts are that this is a Kentucky not-for-profit corporation. It was primarily set up for the purposes of raising money for the conservation and maintenance of a park in Louisville, Kentucky. The corporation had the fundraising event in 2012 and incurred some financial losses in 2012. Corporation was administratively dissolved in 2013. It was reformed and administratively dissolved again in 2014. And then in 2015, the individual taxpayer got the bright idea from somewhere that they would file a late S election for the not-for-profit corporation, file late 1120S tax returns for the not-for-profit corporation in 2012 and 2013, and then, of course, file some late 1040s for himself to report those tax losses from the fundraising event on their own individual 1040. Not surprisingly, creative, I guess, but ultimately not surprising that was not successful. The tax court ruled that a not-for-profit corporation is not an S corporation. Kentucky's law, similar to Florida's law, and I suspect the law of most states, which the state law prohibits not-for-profit corporations from making distributions or dividends to its members, its directors, or its officers, also prohibits the issuance of stock. tax court couldn't find any authority for where an individual or anybody would have a beneficial ownership interest in a not-for-profit corporation. And so at the end of the day, shareholder or the taxpayer lost, and the court concluded that the individual is not an S corp shareholder under the 1361 regulations. The court also rejected two other arguments the taxpayer made, despite the sort of late S election filing. One was that they intended a for-profit corporation all along. Tax court rejected that. General idea, right? You're sort of stuck with the form of entity and business that you're using. And also the taxpayer tried to advance the argument that because they had not applied for tax exempt status for this not-for-profit corporation, it therefore must be treated as a for-profit corporation for income tax purposes. Again, that was also rejected. Moving along we all know, of course, in the TCGA in 2017, we have this $10,000 SALT cap that's imposed on individuals that itemize. A question had been, how does that work for S corporations and partnerships that pay state and local taxes, and pass that through? Last fall, IRS came out with Notice 2020-75, where they said that they were going to issue proposed regulations, but the concept of those regulations would be that state and local taxes paid by an S corporation or tax partnership are allowed as a deduction by the S corp and the partnership in computing its non-separately stated items, and so it would flow out and would not impact the $10,000 SALT cap imposed upon S corp shareholders and partnerships. And of course, there's a lot of talk. There was an article that came out a couple of days ago. A lot of cities and municipalities lobbying Congress for repeal of that $10,000 SALT cap. So maybe that will go away. Next issue I'll hit on is some final regulations that came out because of some legislation flowing out of the TCGA. Got these final regulations came out last fall, making it easier for S corporations that are converting to C corporations. The TCGA added two new code sections, 41D and 1371F. And under these sections and the final regulations, they basically make it easier for a cash method S corporation to convert to a C corporation. And of course, generally C corporations are accrual method taxpayers. What the code and the regs provide here is if you meet three conditions, then any adjustments, tax adjustments you have from changing from the cash to accrual method, you can take that adjustment ratably over a 6-year period, starting with the year of conversion, instead of having to take that entire adjustment in the year of conversion. And usually when that conversion happens, there's an income recognition event. And so being able to recognize it ratably over 6 years rather than all in the year of conversion provides some deferral benefit. The three conditions to be satisfied, the S corp must have existed prior to December 22nd, 2017, which is the date of enactment of the TCGA. The conversion from S to C status must have taken place prior to December 22nd, 2019. And all of the shareholders in the S corp and the C corp must be the same and must also have the exact same ownership percentages. And so an S corp that meets this, the code refers to it as an eligible terminated S corporation, or ETSC. The second part of these regs, they deal with new section 1371F. And what that section provides, and is clarified in these final regs, is that money distributed by one of these ETSCs after the post-termination, post-S corporation termination transition period, which is generally a 1-year period, those money distributions are allocable to and chargeable against your accumulated adjustments account, your AAA, in the same ratio that the AAA bears to the now C corporation's earnings and profits. And this treatment is taxpayer friendly because under the old or normal sort of 1371E rule, you could take distributions of money against AAA before, but not after the end of the post-termination transition period. So the practical effect here is that these ETSCs, these S corporations that meet these requirements to convert to C corporation, they can make otherwise non-taxable basis, reducing distributions of money under their AAA during the 1-year period following the post-termination transition period. Excuse me. Another item that came up several times last year, there's a whole series of letter rulings issued by IRS dealing with a scenario where you have a limited liability company that's taxed as a partnership, and it converts to an S corporation, but for some reason, some communication breakdown, I guess, between the CPA, the lawyer, the client, they never amended their operating agreements. And so their operating agreements still have all the partnership tax language in there. And the issue in all of these letter rulings is that these partnership tax distribution provisions had preferential distribution rights. And so you're violating the one class of stock rule in the S corporation rules because, you know, different partners are now have varying distribution and liquidation rights. So in all the rulings, the taxpayer was successful in convincing the IRS that it was an inadvertent termination of the S corp status, and so the S corp status was restored. But of course, you know, the key takeaway here, of course, none of you would do this, but make sure that, you know, if you've got clients in that situation, LLCs converting from tax partnerships to S corporations, that you're making sure you're stripping out all that partnership tax language and putting in your S corp language. I know in our office, we just completely amend and restate the entire operating agreement, so you don't have anything sort of left kind of hanging out there. The last item I want to touch on is a ruling that it's not in the materials because it came out June 25th, so it just came out a little while ago. It's in the 1202 stock context, which has kind of been seemingly a hot area the last year or so. It's letter ruling, it's 2021-25-004. And just by way of background, you know, 1202 provides an exclusion from gain for stock of corporations that meet certain requirements, including that the corporation is a C corporation, and also that it meets an active business requirement during substantially all of the taxpayers' holding period for the stock. And under this active business requirement, 80% or more of the assets of the corporation have to be used in what's called a qualified trade or business. And 1202 kind of defines what is a qualified trade or business by telling us what it's not. And what a qualified trade or business is not is the performance of services in the fields of health, law, accounting, and a whole other long laundry list of businesses, where the principal asset of such trade or business is the reputation or skill or one or more of its employees. And the issue in this ruling was a corporation that manufactured healthcare products prescribed by third-party healthcare providers. And so the question was, is this the field of health where it's services, or is this more manufacturing of products? And the service, I think not surprisingly, concluded that this was not the field of health. It was not the services in the field of health. This really was the manufacturer of tangible personal products, property. And so the corporation qualified for 1202. And also, I think by analogy, this ruling can also be looked at in the 199 Cap A context. You'll recall in 199 Cap A, there Congress borrowed this qualified trade or business exclusion that we find in 1202 and incorporated that language into the definition of what is a specified service trade or business in 199 Cap A. Of course, there's one key difference. In 199 Cap A, the architects and the engineers got a gift, and they were carved out so they could take advantage of 199 Cap A. Still bitter that the lawyers didn't get that exception, or the accountants. But nonetheless, I think there is some applicability here if you're looking at what is a specified service trade or business. And that concludes my update on business entities. And thank you so much.
Thank you, Mike. That was a great presentation. Thank you for the update. Our next speaker is going to be Scott St. Amand. He'll be coming up in a second, but let me just mention a couple of other housekeeping items that I forgot to mention at the beginning. First of all, I think we've now muted everybody, but apparently there was some fun on the Zoom call, right? There's those people who forget they're on the Zoom call and are talking and all that. And just a service to remember to mute yourself when you're on Zoom. But I believe we've now muted everyone. There was and by the way, one of the good things about, silver lining about COVID is that we blame everything that happens on the coronavirus, right? We're continuing to do that. So there were some typos in the material as far as the presenters, and that is all coronavirus's fault. So just so you know, we could continue to do that for another 6 months. And then I think we have to agree that we can no longer blame coronavirus for everything. So I think we're going to agree to that today. If you need the material, some of you who are here in person might not have formally registered for this separately. I don't know if you got a link to all the materials. During the break, you can go out and ask those materials to be emailed over to you, and you'll get today's materials. The other thing I wanted to mention is that we have 41 people in person registered. I think maybe a few of them are at the beach, but we have a pretty full room here. And we have 98 people who are virtually attending today. So I'm also a CPA originally. To me, that sounds like 150 if we're rounding up maybe. So I'm going to take the liberty to do that. So getting back to our speaker, Scott is an attorney with Fisher, Tazzy, Elias, and Ball. I think that's Harris's firm. And he has an LLM in taxation from the great University of Florida, which I can say my daughter just started there. So now it's the great University of Florida. I think it was always the great University of Florida. And he publishes very frequently, Florida Bar Journal, Tax Section Bulletin, Tax Notes. And if you come up to the stage, Scott, please take it away.
There we are. Thank you, everybody, for attending in person and those of you out in the Zoom world. As mentioned, I am a senior associate at Fisher Towsey in our firm's tax controversy department. I do have the pleasure of working with our new chair, Harris Bonnet, and sharing a wall with Harris Bonnet, and hearing all of the tax section business through said wall. I'm going to take 15 minutes today to talk about a code section that was, before 2020, pretty widely ignored by practitioners and petitioners and the IRS itself. Let's see. There we go. Though it may shock the conscience of some of the younger tax attorneys in the room, prior to 1998, the Internal Revenue Code did not actually require revenue agents to explain to taxpayers how they had actually arrived at the amount of penalties asserted against the taxpayers. There's not a great deal of legislative history to 67B1, or 66. We'll get to it. There's not a great deal of legislative history, but it's clear that the proponents for changing the policy believe that the IRS could and often did threaten to assess the penalties against taxpayers in an effort to strong arm them into settlement. So in one of the hearings before the Senate Finance Committee, and you can see the quote on the PowerPoint, the incoming chair of the American Bar Association tax section noted that the IRS will often say, if you don't settle, we will assert penalties. And it's this threat of penalties that Congress really wanted to do away with. So in 1998, the IRS Restructuring and Reform Act was passed, and in part to level the playing field between the IRS and the taxpayers. Congress said that penalties should only be imposed where appropriate and not as a bargaining chip. And this term bargaining chip shows up a lot in the 2020 opinions that we'll talk about. So when the act took effect, it required that the IRS actually give notice to the taxpayer what the penalty was, explain what authority the IRS had for asserting the penalty, which is just to say under what code section they were asserting the penalty, and to show the taxpayer how the penalty was calculated. But most importantly, the act required the IRS official who made the call that penalties were to be asserted must have attained approval in writing from his or her immediate supervisor before ever formally communicating the decision to the taxpayer. This second requirement, Congress hoped would forestall the use of the bargaining chip / strong arm tactic. 6751 A states that the IRS must provide notice to the taxpayer if it asserts a penalty, reference to this title being Title 26, obviously. Further, the IRS must include with every notice the penalty's name, code section, and most importantly, the computation of the penalty, because anyone who deals with the IRS on a regular basis knows taking the IRS's computations as gospel is a dangerous prospect, unwise, and sometimes costly. But most importantly, 6751B1 says that the IRS cannot assert, much less assess, a penalty without first obtaining supervisory approval. Let's look at the exact language of 67B1, which says that no penalty under the Internal Revenue Code, under this title, shall be assessed unless the initial determination of such assessment is personally approved in writing by the immediate supervisor of the individual making such determination, or such higher level official as the IRS or as the secretary may designate. Now, it's important to note right now that there are no regulations, proposed or otherwise, on 6751. So as it stands now, the approval must come from the immediate supervisor of the IRS official making the determination. As we'll see later in the McCarthy case, this comes into play, and will probably come into play a bit more when IRS official just signs their name, doesn't designate who they are. There's no proof of who they are. But we'll get to that with the McCarthy case in a bit. So 6751B2 and B and C. So even though the IRC 6751 says all penalties under the code, it's just a little white lie that the Congress told to make taxpayers sleep a little bit better at night. In reality, 6751B1 will never apply to the failure to file penalty under 6651 or the failure to pay penalty for estimated tax due for an individual under 6654 or a corporation under 6655. Further eroding Congress's little white lie, 6751 does not apply to any other penalty calculated through electronic means, and we'll come back to that one in a sec. So to recap, the penalty means penalty in all penalties, except when it doesn't. Clearly, this will not come back to bite the IRS in its administrative butt, but we will see. So the first time that a petitioner actually raised 6751 or 6751B1 is 2015. So that's 17 years after the act passed. Unfortunately, the petitioners, and there were two cases in 2015 that raised 6751, were also exceedingly frivolous cases. And so made by pro se tax protesters. And so the theory of 6751 did not progress very far at that time. As an aside, one questions how they actually stumbled onto 6751 for the first time, but here we are. The first real challenge came in the 2015 case of Chai versus Commissioner, which the underlying opinion in Chai is not as important as the Second Circuit's decision in which it completely rebuked the tax court. And so between the Second Circuit's decision in Chai and Judge Gustafson's dissent in the Grave line of cases, there were 3 Grave cases. The stage was set for all of the decisions that would come out in 2020. I will talk briefly about Clay because it does set the stage for what exactly a formal communication is. Clay expanded on Chai and held that the penalty approval was required before the IRS formally communicated that it intended to assert a penalty and notified the taxpayer of the right to appeal those penalties. So it's this communication that penalties have been determined that constitutes an initial determination. The communication must be formal, but formal in this context might be better thought of as unequivocal. No cases have been published that the communication must formally be in writing, only that the approval from the supervisor must be in writing. But it's likely not that a simple mention or threat of a penalty to a taxpayer will rise to the level of initial determination, even though that is exactly what Congress wanted to stop. So the first full opinion in 2020 was the Bel Air Woods Inc. v. Commissioner case. Came out in January of 2020. The taxpayers in Bel Air received a letter 1807, which just practically invited them to a closing conference to discuss the proposed adjustments. The letter also indicated that all proposed adjustments in the report would be discussed at the closing conference. So it was clear in Bel Air that the IRS exam division had not finished its analysis. And so the court in Bel Air held that a mere proposal of penalties combined with an offer to discuss and mitigate them was not an initial determination requiring prior supervisory approval. The next case, Frost, came out a day after Bel Air. You got the first of the first 6 full tax court opinions in 2025 were on prior supervisory approval. So we got a spate of cases in January of 2020. In Frost, the tax court looked for the first time at the procedural nuances of 6751B1. The tax court observed that under 7491 and the Higbee case, which you may or may not be familiar with, that the IRS bears the burden of production regarding an individual's liability for any penalty. It follows then, if they bear the burden of showing the individual's liability, that they likewise bear the burden of proving that they received supervisory approval. The IRS must produce credible evidence of prior written penalty approval as part of its initial burden under 7491C. Critically though, the IRS only bears this burden if the taxpayer actually raises the issue. You may have read the behemoth 271-page opinion on the Michael Jackson estate written by Judge Holmes, who's my personal tax court hero, just because he's sarcastic as anything and does not tolerate stupidity on either side, and will unabashedly say so in his opinions, and he likes puns, which just endears him to me. Simply challenging the penalty, the underlying penalty, is not enough to challenge the supervisory approval of the penalty. So a taxpayer must separately and affirmatively challenge the supervisory approval of such penalty. Laidlaw's Harley-Davidson sales is probably the most important of the full opinions that came out in 2020. Not only did the tax court affirm that 6751B1 applied to assessable penalties, which must be approved before the initial determination. Assessable penalties, meaning that no statutory notice of deficiency need be issued before the IRS can assess the penalties. So in Laidlaw's, the tax court affirmed that 6751 applied both to assessable penalties and penalties requiring the IRS to follow deficiency procedures. And further, Laidlaw's extended the prior supervisory approval into CDP hearings. What I mean by that is, as part of the CDP appeal process, the appeals division must receive proof from the IRS that the requirements of all applicable laws and administrative procedures have been followed. When the supervisory approval requirement applies, appeals must receive verification from exam that approval was obtained before allowing collection to proceed. Importantly, from a strategic point, if they don't, if appeals doesn't, then it's an abuse of appeals discretion, which we all know is very difficult to prove ordinarily, but in this context, fairly easy if there's no proof that supervisory approval was received. The next opinion was Chadwick, the commissioner. It extended the prior supervisory approval requirement to the trust fund recovery penalty. As we said before, penalties are penalties, except when they're not. And the trust fund recovery penalty is such a penalty. I have a 3-year-old and it's kind of the Cookie Monster test. If it looks like a cookie and smells like a cookie and tastes like a cookie, it must be a cookie. Same applies to penalties, except for the failure to file, failure to pay, and automatically calculated penalties. So the IRS argued that the trust fund recovery penalty was not a penalty, even though it's called a penalty, did not succeed. The initial determination in Chadwick was the 60-day letter or the 1153. Chadwick is also notable because the tax court said that an electronic signature, stamp, or other means of written evidence is all that is needed to show supervisory approval. You don't actually need a physical signature. And so that was the first step in that direction. And other cases to come out later would expand on that, saying that an email from a supervisor would be fine because it's in writing and from the supervisor. So the next opinion we'll touch on briefly is Thompson. In the vein of Chadwick, Thompson held that a preliminary settlement offer, noting that exam still had work to do, wasn't enough because exam hadn't concluded their work. Penalties hadn't definitively been decided. The next one, Oropeza, is kind of an interesting one. In Oropeza, the IRS didn't get approval for the accuracy related penalty under 6662A and B6. So they thought they would kind of do an end around. And so they got approval for a 6662I penalty, which is for engaging in a transaction lacking economic substance. The tax court likened this to a criminal case, an aggravating factor. See, the IRS didn't prove the underlying offense. They couldn't prove they couldn't assert the aggregating factor. McCarthy was an interesting case that when the 6751B1 says immediate supervisor, it means immediate supervisor. In this case, the penalty approval sheet was signed by Felicia Broadnax. The only trouble was no one knows who the hell Felicia Broadnax is, and the IRS couldn't prove it, and so they lost McCarthy, and Felicia was the downfall. The Coe case extended prior supervisory approval to the Office of Chief Counsel. If in the amended answer, Chief Counsel asserts an additional penalty or asserts a penalty for the first time, that's fine so long as the Chief Counsel attorney's supervisor approved it. Patel takes it a step further. The tax court won't look behind supervisory approval. If there's supervisory approval, the tax court will not determine whether or not the supervisor gave sufficient consideration to whether the penalty should be asserted. Prior written supervisory approval requires just that. Written supervisory approval, nothing more, nothing less. And we had a few full opinions come out in 2021 so far. In Grajales, I hope I'm pronouncing that right, the penalty, as the petitioner argued, was the 72T1 early withdrawal addition to tax. Now, I'm guilty of this too. Often we refer to the 72T1 exaction, as the tax court called it, as the early withdrawal penalty. If you look at the code, it actually says it's an addition to tax. So it is or an additional tax, not even an addition to tax. So because of that, 6751 didn't apply to the early withdrawal exaction. Walton is interesting because it carved out an exception to the penalty under B2B, which says any penalty that it was determined mathematically by a computer software program without the involvement of a human examiner is not included in the prior supervisory approval requirement. And this is interesting, and there's actually a really neat article written in the Minnesota Law Review in the materials that were emailed to everybody. A link to that opinion is in there. We'll skip ahead because I know I'm running kind of late. The Plentywood drugs case is interesting. Again, the supervisory approval requirement is, the burden is on the IRS for an individual. Plentywood Drugs says if you're a corporation, and the estate of Michael Jackson's case says if you're an estate, a non-individual taxpayer, you bear the burden of proving that the IRS did not receive approval. That is achieved through a FOIA request and just submitting documents. So I'll end there. I would recommend reading the article on what exactly electronically determined means. It's a very interesting distinction that the IRS is arguing that all accuracy-related penalties are automatically determined. But if a revenue agent had its hands on the case at any point, then it's not automatically calculated. Thanks everybody for your time. Thanks Zoom people.
Thanks a lot, Scott. That was a great presentation. And every year at Ullman, we'd like to get associates to present. It was a little harder this year because I made a rule that you had to be an in-person presenter, right? So the in-person people, they don't like when someone presents on the screen. So that was one of the rules. And we did get an associate, and now we have some more associates, I believe, who are presenting. But before we go to that, I've heard that a couple of people are having trouble getting the materials. I don't know if it's going into your spam or sometimes the email is too large. If you're having an issue, contact Sheridan Hughes, email our administrator, shughes@floridabar.org, and she'll get right on that. So thank you very much. So our next speakers, Ansell Fernandez, I think is going to be doing inbound, if I have this right, and Scott Snyder is going to be doing outbound international tax. Do I have that more or less correct? All right. I'm getting kind of a mixed signal on that. I don't know what that means. Maybe they're doing a little bit of both, or it's complete opposite. We'll find out. Ansell is with the firm of Holland & Knight, great firm in the Miami office, and he's a Georgetown LLM. Scott, who also does internet, they both primarily practice in the international tax area, I believe. They didn't, by the way, I don't think you guys sent me your bio, and I had threatened, had you sent it? Okay. Another coronavirus glitch. Okay, Scott's with Fox Rothschild in Miami also, and went to UM School of Law and also for LLM. Okay, I didn't have a glitch there. So why don't you guys come up and teach us some more about international tax?
Let's see. Okay, here we are. Okay. Good morning, everyone. So we've been tasked with providing an international tax update, both inbound and outbound. However, the last 18 months, we've had a bunch of guidance in this area. So what we've decided to do is we don't want to overwhelm you with a bunch of international tax updates. So what we are going to be doing is we selected a couple of key updates, and we're going to be going into a little more detail into those updates. And then at the end of the presentation, Scott is going to run down through a collection of other notable updates that we think are important. So for my part, I'm going to be talking about RefProc 2020-20, which was one of the most hotly commented and debated RefProcs when it came out in 2020. And I'm also going to be, if I have enough time, I'll be talking about RefProc 2020-27. Now, what these two RefProcs have in common is that they were both issued by the IRS to provide relief to individuals that were impacted by COVID-19 travel restrictions, which was, of course, a big issue last year and still is. But just to provide a little background, if we go back to last year and we think of, the months of February, March, April, those were the months when many countries around the world, including the US, they started instituting travel restrictions. So they wouldn't allow anyone coming in, no one going out. And as a result, you had many non-resident aliens. And what I mean by non-resident aliens, when I mention non-resident aliens, I'm talking about individuals that are not citizens of the US and individuals that are not green card holders. So I'm going to refer to them as NRAs because I don't want to keep saying the word alien. So NRAs are individuals that are not US citizens, not green card holders. And this is a big deal for them because if a non-resident alien, an NRA, if they spend excessive amount of physical presence days in the US, they can become US income tax residents. And this is important because a non-resident alien, NRA, keep saying alien, the way they get taxed generally is they get taxed on certain types of US sourced income and other income effectively connected with a US trade or business. That's it. Now, if they spend an excessive amount of days by meeting what's called the substantial presence test, and I'll talk more about that later, then they would become taxable on their worldwide income. In addition to being taxable on their worldwide income, they would also have compliance issues. They would have to submit a bunch of reporting to the IRS. And trust me, the clients that I've dealt with, they don't want to be doing that. So just to provide some background so you can follow up, the substantial presence test, as I mentioned, is the way that a non-resident, an NRA, becomes a US income tax resident. The way it works is the first thing is the year that we are determining whether the NRA is a US income tax resident, that person has to be in the US, physically present in the US for 31 days. And then we apply a weighted average formula. And if the days of physical presence that end up being included equal 183 days or more, then that individual will be, that NRA will be considered a US income tax resident, taxable on their worldwide income. And as I mentioned, they would have a bunch of compliance issues as well dealing with reporting. So this is just an example here. And sometimes many practitioners tell their NRA clients, and this, people, many of them are sophisticated. So they know they need to keep track of their days of physical presence in the US. And many of them know that if you stay for 121 days or less every year, you will never violate or meet the substantial presence test, as you can see in this example. And they plan themselves around it. Now, imagine if you are stuck in the US and you need to, because you cannot leave, because you cannot go into your country, because you were infected with COVID, or because you're afraid of being infected with COVID. So this was a major question before this RefProc came out. So just going into the RefProc, this is the reason why the RefProc is so important. So the RefProc basically allows an NRA to exclude up to 60 days of physical presence for purposes of the substantial presence test. Now, the NRA has to be an eligible individual, which means that the NRA cannot be a resident of the US in 2019, cannot be a green card holder in 2020, must be actually physically present during those 60 days if they are excluding them. And then also does not become a US resident in 2020, but for the COVID-19 emergency period. Now, as I mentioned, they can exclude up to 60 days of physical presence. So just to go a little bit more into that, the 60 days of physical presence, in order for it to be excluded from the calculation of the substantial presence test, those 60 days actually have to start on a date that is on or after February 1st, 2020, and on or before April 1st, 2020. Important to say that the NRA does not have to be actually infected with COVID or anything like that. As long as they meet these requirements, they can exclude those 60 days. So just briefly, this is going back to example 1. Here we have the same NRA that planned themselves around the 120-day rule, and then they can, for 2020, they can exclude up to an additional 60 days. So for 2020, they could, in theory, exclude up to 181 days, and they wouldn't meet the substantial presence test. Now, even if the NRA, after applying the REFPROC, even if they meet the substantial presence test, the NRA can always use something called the closer connection exception. I don't have enough time to go into it, but under the closer connection exception, there is also a test in there, a physical presence test. And important to say that the REFPROC, the 60-day rule, where you can exempt days of physical presence, can also be used for purposes of determining whether the NRA can use the closer connection exception. Then, even if the NRA does not meet the closer connection exception, you can always use a treaty tiebreaker procedure under a U.S. income tax treaty. But that's a separate question. In addition, the REFPROC can be used to determine the taxing jurisdiction over personal service income performed in the U.S. So this is the case where you have an NRA that was stuck in the U.S. They are performing services, personal services for a foreign employer. And then the question becomes, who is going to tax this income? If the NRA is a national of a country with which the U.S. has a U.S. income tax treaty with, then for purposes of, under those treaties, there are specific qualifications in there to determine what taxing jurisdiction is going to have jurisdiction over this income. And the 60-day rule, the ability to exclude 60 days of physical presence, can also be used for purposes of the U.S. of a tax treaty for purposes of personal services performed in the U.S. So it can be used for the substantial presence test, it can be used for the closer connection exception, and it can also be used for purposes of determining who has taxing jurisdiction over personal services performed in the U.S. Now, to claim the relief, if the individual has a 1040-NR filing requirement, then they simply attach a Form 8843 to their 1040-NR. If the individual does not have a 1040-NR filing requirement, then they don't have to file anything. They just hold on to the documentation for 3 years. If they want to take advantage of the tax treaty benefit that I mentioned, they file Form 8233. And that's it. So that's in the case of an NRA that gets stuck in the US because of COVID-19. Now we're going to change gears and we're going to look at a US taxpayer that has a tax home in a foreign country. So in that case, these taxpayers usually take advantage of the foreign earned income exclusion under Section 911. Now, in order to qualify, and I'll speak briefly because my time is up, in order to qualify for this, the qualified individual has to, one, have a tax home in a foreign country, and then either be a bona fide resident of that foreign country for an entire taxable year, or be physically present in that foreign country for a specified amount of days. Now, because of COVID, many US taxpayers did not want to be locked out of the US in some cases, so they came back to the US. In many cases, they could not leave the US back to their tax home. And for that purpose, they would not be a qualified individual for purposes of the foreign earned income exclusion. Under this REFPROC, those timing restrictions as to whether they're a bona fide resident of the tax home, or for purposes of the physical presence timing restriction under the definition of qualified individual, the REFPROC basically relaxes those restrictions. And generally, there is a lot more requirements into this, but generally, if the individual can prove that they have a tax home in a foreign country, they'll be able to claim, they'll be able to take advantage of the foreign earned income exclusion. That is all my time. I'm gonna pass it over to Scott. Thank you so much. I look forward to meeting all of you and having a fun weekend. Thank you.
Let's see. All right, so I'm going to go through some of the additional updates. These are pretty complicated, so we're not going to get into the background of the underlying rules. They're somewhat nuanced, but we're going to try and just cover some important ones. In particular, to start off, in 2021, we had the final PFIC regulations issued, and they largely adopted what was done in the 2019 proposed regulations. Basically, you know, they had a couple of focuses, one with foreign corporations with US owners, and if they were going to issue or offer their shares to US investors, they provided some ability to determine whether or not you had PFIC status. They also applied US persons for direct or indirect ownership, and we're going to go through some examples in the attribution rules. So for certain foreign corporations that were going to IPO in the middle of the year, they provided rules in terms of whether or not you had to provide information for prospective shareholders to determine PFIC status. And then one other thing that they had to address was the repeal of 958B4 and try and reduce the amount of corporations that will qualify under PFIC rules as a result of that repeal. So in relation to the attribution rules, one of the things that's been a focus is the attribution through pass-through entities, S corporations, partnerships, trusts, and estates. And we're going to go through some examples. We don't have a ton of time, so I think the examples will help explain this. So let's go down. The overarching concept of this is they still apply the top-down approach. The top-down approach, again, is going from the shareholder level down through the tiers of successive companies. And as it relates to partnerships, the final regs basically made some slight modifications to the rules and the examples as to how this rule would apply. So if we go through example one, you have a situation where you have an individual who's a US citizen. They own 100% of a Delaware corporation and also 49% of a BVI corporation that's not a PFIC. And the BVI corp, let's say, owns 100 shares of a PFIC. So the question is, okay, how do these rules apply? So first, your domestic corporation, the Delaware C Corp, because it owns more than 50% of the underlying foreign corporation, the BVI corp, it will own 51 shares of the PFIC. Your individual has the direct 49% ownership and 100% ownership of your domestic corp. So the individual would, if you follow the rules, would own all 100 shares, but there is a limitation that's going to say, look, because of the rules under 1291, you're only going to own your 49%. The domestic corp is going to own 51. And we're going to see how this changed now when we insert a partnership in example two. So example two, we have a situation where you have an individual that's in a Canadian limited partnership, for example, with unrelated NRAs. The Canadian limited partnership then has an interest in two foreign corporations, FC1, FC2. It owns FC1 100%, FC2 50%, with other unrelated NRAs. And both those foreign corps have 50% interest in a PFIC. And so if you follow the attribution rules down, what the rules tell you is you need at least 50% ownership. So for individual B, who's going to own FC1, they own 50% through the attribution rules of FC1, and they own 25% of FC2. So because they don't own more than at least 50% of FC2, they're not attributed the shares, the PFIC shares of FC2. However, for FC1, they would be attributed 25% of the PFIC shares, which is your 50% times 100 times the 50% that FC1 holds. So if we modify that example a little bit in example 3 and reduce individual B's ownership to 40% in the Canadian limited partnership and keeping everything else the same, what ends up happening is individual B no longer gets attributed the shares of FC1 because now you have 40% ownership in FC1, which doesn't meet the at least 50% requirement. So you no longer attributed FC1 shares of the PFIC. And similar to the previous example, you're also not attributed the shares of FC2 because you didn't have at least 50%. And the final modification, well, what happens if you have a direct ownership in FC1 directly in addition to your ownership through the Canadian limited partnership? So in this example, what we did is we took a 20% direct interest in FC1 and reduced the Canadian limited partnership's interest by 20% to 80%. So what happens is you do the same thing we did before. You take your 40%, multiply it by 80% this time, and now you have a 32% interest. But because you also have a direct interest of 20%, that gets added on to raise you up to 52%. As a result of being at 52%, you then are attributed the shares of FC1. So you have 50% of that, it'll reduce you to 26%. And then for FC2, it's the same result. You have 40% and you're only going to own 20% of FC2, which is not enough to attribute FC2's PFIC shares. In 2021, we also had proposed PFIC regs that were issued. They provided 3 main things. A lot of it related to insurance businesses and stuff, which is kind of rare for people to encounter. But the other area that was actually highly applicable to a lot of people doing PFIC analysis was the determination of a PFIC. And for those of you that are familiar with PFIC tests, you know that there's an income test and an asset test. Well, specifically, this relates to the asset test and working capital. So a lot of people have encountered situations where you have what we call accidental PFICs, where you have PFICs that have too much cash. Cash is a passive asset under the test. Well, now we have a little bit more to work with in relation to cash that's being used for working capital. So what did they do? Basically, what they said for the asset test is if you have working capital, if you have cash, and it's denominated in the functional currency, it's held in a non-interest bearing account, it's going to be used for the present active trade or business, and it's no greater than the necessary amount to cover your expenses, and you reasonably expect to pay that within about 90 days, it's not going to be treated as a passive asset. So for a lot of companies that have cash infusions, high expenses, contingencies, things that they need cash for, we were running into situations where these would be PFICs because they were holding too much cash. So this was a way to somewhat solve that issue. It is really narrowly tailored, but it could be helpful. So these were just issued this year in the proposed regulations. Again, could be pretty helpful. The final thing we'll just go through really briefly was the final regs under 721C. Basically, this was a provision that turns off non-recognition under 721A when you have a contribution of appreciated property with related foreign persons. There's basically a method that you can use. It's called the remedial allocation method under the partnership rules, and there's a gain deferral method. All you really need to know with this is, again, if you have related foreign persons and you're contributing appreciated property to a partnership, you have to be very, very careful that you now do not have to turn off your traditional non-recognition rules under 721A as a result of these regulations under 721C. The rules are pretty complicated, so you really have to kind of dig into this, but the overarching point is they're trying to prevent abuse, people shifting taxable income or what would have been taxable income from US persons to non-US persons through the use of a partnership. But unfortunately, the way 267 works with attribution rules and all these complicated rules to determine related party, you could be tripping this rule up pretty easily. So you have to be very, very careful. Lastly, as Ansell mentioned, we had a bunch of notable updates, and I'll just briefly list them for you. We had final regs under dividend received deductions for 245 cap A. We had final regs for excess dividend distributions under 951 cap A for guilty. We also had the guilty high tax exclusion come through in final regs under 951 cap A. We had final regs related to section 250 for FDII and guilty. There were also some regs under section 958 to address the repeal of 958 before. We had final regs issued under 163J for excess business interest deductions limitation. We had regs issued for foreign tax credits for 901M. We had further final regs also issued for 1446F for transfers of partnerships by foreign persons. We also had regs under the anti-hybrid rules under section 267 cap A. We also had final regs issued under section 482 for intercompany agreements. And then we had final regs under section 864 for sales of produced inventory property. And lastly, there were final regs issued under 1441 related to relaxed signature requirements and documentation for foreign taxpayer identification numbers. With that, I'll leave you guys. I see my time's up, and hope you have a great weekend. Thank you.
Well, good morning, everyone. My name is Harris Bonnet, and I'm the chair of the tax section of the Florida Bar. And I'm here to introduce our next speaker. Before I do that, I'd like to take a moment and just, for those of you who are here in person, to remind you of some of our activities coming up. And so, for example, later this afternoon, we have our chairs reception, which with a lot of great food and beverages. And for those of you who are here, I hope you can attend. Of course, tomorrow morning, we have our typical tax section administrative meetings, culminating in the executive council meeting. And then for tomorrow evening, we have our family dinner with a lot of great fun planned. Sunday, we'll have our 5K fun run and walk, as I will be doing. And then we have our fireworks and ice cream event on Sunday evening before we leave on Monday morning. So with that, I have the pleasure to introduce our next speaker, Mark Brown. He practices with the law firm of Commodore Singer, Baseman and Braun in Palm Beach County. And his practice is in wills, trusts, and domicile planning, probate administration, and estate, GST, and income tax planning. He earned his BS degree in accounting summa cum laude from the State University of New York in Albany. He got his JD from Duke. And with that, I am pleased to introduce to you Mark Brown.
So when you're chair of a program and you have a rule that the speaker has to be in person, sometimes you have to fill in and present too. That's a good lesson for all you people who chair events in the future. There's a lot going on in estate planning. By the way, I give permission to any estate planners in the room if you need to be on your laptop doing documents while I'm presenting. I completely understand. It's just complete uncertainty in the estate planning world, which is creating a lot of work. People just don't know what's going to happen with the exemption and all these other rules. But before I get to that, and it's not in my material, there's some recent developments that just came out, Florida law. And I checked with French Brown. I don't think this is in his outline, this stuff. French, if it's in your outline, let me know, start waving, and I won't present on it. House Bill 625 has to do with compensation for attorneys. So everyone should be listening to this point. If you're an attorney for a personal representative or attorney for a trustee, effective October 1st, 2021, you're gonna have to make special disclosures if you wanna take those statutory fees. A lot of estate planning attorneys, all I have to do is mention the statutory fees under, I believe, 733-6171, and they know exactly what I'm talking about. I have the bill with me. If anyone wants to read it at their leisure, House Bill 625. Of course, you could have Googled it already and brought it up. And basically what it says, if you intend to charge a fee based on the schedule, so like an attorney, you read through that based on the schedule, what does that mean? What if it's 75%, 95%, whatever percent? I'd make sure I did these disclosures if I'm taking a statutory fee. You have to make the following disclosures, and there's a list there. Like this isn't a mandatory fee, those kind of disclosures. The one that's interesting is a personal representative shall be entitled to a summary of ordinary and extraordinary expenses rendered at the conclusion of the representation. So my takeaway on this is that you better do this in your engagement letter at inception if you're going to take statutory. And if you don't, then you either are going to need, it looks like, a court order, which is always fun, or all the interested persons to consent in the case of an estate, which is also fun because the definition of interested persons is broader than qualified beneficiaries. For the trust case where you're taking statutory fees, it's qualified beneficiaries, but you don't want to go there, right? This is easy. If you're doing an engagement letter, I would start today. Don't wait, because what is the beginning of the estate? Who knows? Just do it now. Look at the House bill. I'm going to throw it over here. Anyone wants to look at it, you can. The next thing that came out, community property trust legislation was signed. By the way, these have been signed by the governor. Both of these that I'm mentioning. This is not just fake law, which we're going to talk about soon. This is actual real law. That's what's fun about it. The community property trust signed by the governor effective July 1st, 2021. You could already do one of these right now while I'm presenting. And this is the ability for you don't even need to be a Florida resident. You can adopt Florida law and treat property as community property. Typically, the reason why you want to do that is to get the double step up in basis. But in Florida, the trade-off is you don't get tenancy by the entireties. You don't get creditor protection. So you're trading off creditor protection versus double step up in basis, which is always fun. We don't have the asset protection rules, the self-settled asset protection stuff. So, if you want to do that, you're going to have to go to Alaska or one of those other jurisdictions. Just some takeaways. It's got to be signed by both spouses in accordance with the formalities under 736. So most cases, that's going to mean you need witnesses. There's disclaimer language that you have to put in this thing. If anyone's looked at the bill, and I think I have it here with me, but you're going to have to say, like, this could be affecting marital rights, and it's in bold on the first page of the thing, which is pretty amazing because we do a lot of things that affect marital rights, like a SLAT, which hopefully I'll get to, but that certainly has a lot of impacts under marital rights, but this has to be in bold. The default is revocable because you're not getting the creditor protection. That probably makes sense, but you could also make it irrevocable. So that's also good, not just for the double step up. Let's say you have a client moving from Texas or California, they can make it clear this is community property. So that's Senate Bill 1070, I believe, and I have some material. I just listened to an hour and a half on this, so I pretty much, in a minute, you got pretty much the same takeaways. Okay, let's get to my outline. The first thing is, by the way, when you're making predictions, that's a dangerous business. People are all over the place right now on what's going to happen. I did the Heckerling program. I've listened to a bunch of presentations since then. I've talked to everyone. No one has any idea really what exactly is going to happen. I'm going to make some predictions, but you have to be careful being in the prediction game. We know the Sanders proposals to reduce the exemption. Mike down to 3.5 million, 1 million for gift taxes. He wants to increase the rate. What's fun if a client asks you, which I've had this question, what's the worst case scenario on retroactivity? Go calculate that with $1 million exemption and increased rates. It's a fun thing to do at home. So we're concerned about that. How likely is something like this to pass? Post-Senate election results in Georgia, I was like, this is a virtual certainty that the exemption is going to go down. But Biden hasn't mentioned it in his proposals, in his Green Book. So I'm going to say this is below 50%. I'm still on record. Just if we go back to next year, I'm going to predict that we will see the exemption go down to 5 million. Plenty of people say no, they're going to wait till 2026. Why even bother? But what's more important is what should you be doing now? Continue to do the slats. I like the idea. I just had this with one client. Let's set up the trust right now, put a little funding into it. And that's kind of nice also to have a grandfather grantor trust. You don't need to put the full 11.7 in, but let's just get that going. Also think about life insurance trusts. Are you going to be able to fund those in the future if the exemption goes down? So maybe do a little pre-funding to your life insurance. The next proposal is on grats. Not to get into it, but if you know anything about this, I just don't know why Sanders isn't just repealing grats, right? I mean, 25% minimum gift or 500,000, whichever is greater. That's more or less an effective repeal of grats. I think this is the most likely of the estate proposals to pass because it's a loophole closer. We were kicking this around in the office, like, where's the constituency for grats? Sure, it doesn't raise a lot of money, but it might be sort of a nice thing for the progressives. They might like doing away with a loophole related to estate tax. What should you do now? Continue to create grats. I don't have to tell you to take advantage of this window of opportunity. There's also the idea that you could create shelf grats where you fund right now a bunch of grats with different terms, maybe park some cash in there or high basis assets, and you have them available in the future if we're able to swap into those and the laws don't change otherwise. He also has this proposal. I mean, the Sanders proposals get worse and worse. I've seen people do an hour and a half just on what you should be doing with grantor trust planning, just in case this passes. What you should be doing today, because they may block the ability for us to do our favorite technique. Really, it's a favorite technique in our office, the sale to the defective grantor trust. Under the Sanders proposal, that would be included in your estate. That would be a terrible result to have all of our grantor trusts included in your estate. Watch the effective date. The effective date would be date of enactment. So it wouldn't even be the end of the year. This would be date of enactment, which is where we make most of our transfers to. So imagine if something like this passed. The quick takeaway, I think it's not a bad idea. And I've heard Blottmacher talk about this, and they think everybody should have one of these in place immediately. Have a grantor trust in place with some money that will be grandfathered, because they're grandfathering in pre-enactment date trusts. Have them in place so you could do sales possibly to them in the future. Or maybe life insurance if you have trouble with the rules going forward. So that's a good idea. In fact, when I was listening to the presentation, they said you should immediately run out and do these for every one of your clients. And I said, wait a minute, I'm pretty busy right now. I don't know if I'm going to do that for every client. All right. Discount planning. We have a couple of sponsors who are appraisers. MPI, Tim Bronze, Roy Myers, MPI. We have Tim Bronze, who's a sponsor. I talked to them about discount planning. Sanders wants to do away with it largely unless you have an active trade or business. I'm going to say this is like unlikely to happen, and we agreed maybe 10 to 20% chance, but it's possible. So once again, grandfather your transactions, close them out right now. The next proposal has to do with GST exempt status of trust, that they couldn't continue for more than 50 years. I don't know if there's a lot of takeaways there. Maybe just make sure that you have that you maybe have a general power of appointment in every trust, an optional general power of appointment. Yeah, maybe a little higher. We got to find the balance on the mic. The next proposal is really this proposal regarding capping annual exclusions. I don't really care that much about that proposal. I mean, it would affect our ILETs a lot, but the ability to have, you'd basically be capped at $30,000 for contributions to trusts and $60,000 for married couples. But forget about that proposal. Here's what I'm worried about. The exemption goes down to $5 million. You used all of your GST exemption now, and you have no GST exemption to allocate to your life insurance trust. So even if you have crummy withdrawal powers, take a note, because we see this on gift tax returns. It's done incorrectly all the time. Just because you have annual exclusion for gift tax purposes doesn't mean you have annual exclusion for generation skipping purposes. And so you might now wind up with difficulty funding that trust going forward. The Biden proposals, these are fun. Nothing on estate tax. These are proposals which I'm almost certain some of these will pass. They're just not the estate tax proposals. It's the corporate rate going to 25%. It's the top rate going up to 39%. One of the reasons I do want to mention it, because I want to talk about retroactivity a little bit. Biden has a retroactivity thing in his green book. It's on capital gains if you have income above $1 million. He has that retroactive to date of announcement in April. And so I'll talk a little bit about retroactivity, hopefully, but we're not talking about retroactivity anymore to January 1st. We're talking about retroactivity, let's say it's to now. You know, they do retroactivity to now, or you're trying to fund a trust and your client misses that date and they fund it after a date of enactment. So you have to watch out on that. One other thing, just remember if you're doing like-kind exchange proposals, Biden would like to cap that where you can only have 500,000 of deferral, $1 million for married couples. And then the big one, which I got to tell you, a lot of practitioners don't think this is going to pass, the deemed realization at death or at gift. You know, that something along the lines of a Canadian tax system. I don't want to spend a lot of time on it because I'm really doubtful on this, but I see other programs on what you should be doing now just in case this passes, including Senate proposals that would have been retroactive to January 1st of this year. The Van Hollen proposal says that transfers to trust, gifts, and the like would be retroactive to January 1st of this year. So that's also fun if you're telling clients worst case scenario on what they're doing, that deemed realization. And by the way, I think the Democrats are going to want to reinstate the SALT deduction, and they have a limited window to do that. So, you know, they may need revenue offsets. Let's go ahead to retroactivity, what you could do to plan for it. And let's think, because we're in July. We're not talking retroactivity to the beginning of the year anymore, which I think is doubtful. It's what if your client starts missing dates? You know, it takes a while to fund private equity. They might miss the funding and fund after date of enactment when the exemption went down to $1 million. One idea that's put out there is the idea that you could have a formula that says, I give away my available exemption, gift exemption, adjusted by essentially the change in the law. We don't know if that's okay. That's the Proctor case that might work. Let me talk about my favorite one, which I think is underutilized. I don't know why this is underutilized. The lifetime Q-tip trust. If you're doing planning for a client that's worried about retroactivity or maybe wants an escape hatch where they say, what if this just completely never happens? Can I completely get out of this without it just being torn up among friends? You know, the marital deduction trust gives you that opportunity. I don't get why the SLAT is everyone's favorite and the marital deduction trust is, oh, I don't want to do that. It doesn't really make a lot of sense. Let me talk about the pros and cons. You have till October 15th, 2022 to make a gift tax election related to a Q-tip trust. You're going to know what happened. Maybe nothing happened. You know, then the Republicans flipped the Senate the next year and you didn't really need to do any of this till 2026. And maybe you didn't ever need to do it if they take control again. So, you know, keep that in mind for the lifetime Q-tip, all that time you have. What about completely unwinding the transaction? Let's say the clients decided they didn't want to do this. Could you make a marital deduction election and then in the future have the independent trustee distribute the assets back to the donee, at least to the donee spouse? That might be a complete exit of the transaction without any tax consequences. Now, I don't know what the IRS would say about that, but the idea is that you could potentially completely reverse the transaction. It's clearly to me, my view is this is the safest approach to any risk on retroactivity, second thoughts, that type of thing, or late funding. The cons about this, oh, the spouse has to receive income. By the way, a lot of my clients, when they're doing slats are like, oh, I'm a little worried about, you know, having access. So maybe giving them income is not the worst thing in the world. They have to be a US citizen. That's true. We just had our international presenters. You can't include a marriage termination provision in the document. That's a key thing. That's a key thing. So it's really hard to turn off grant or trust status. So keep that in mind. Let me just click through some highlights here because I know I let them go a little long so they would have time, our new presenters. Disclaimers back to the donor. That's an idea that's out there by the trustee or the primary beneficiary. Think about that as an option. The rescission doctrine, that's attempting to unwind it because there was a change in the law. No one knows if that's really going to be effective. I have a cite to a revenue ruling in the context of a sale. One of our favorites, of course, on the wait and see approach is to do a sale transaction, get back a promissory note, and forgive the note at the last second. Now, the client's playing with, at this point in time, I'm telling clients, if you're not doing the gifts, you're playing with you might miss the date. right? But if they still want to do that, do a sale, take back a note and forgive it. Now, remember, if you do that in the same year, look at the Bowles case, look at the Nelson case. I think there's a big opening for the IRS to try to say our notes are gifts. This is an addressed issue. And I think people play around with notes and their problems because interest payments don't get made. You know, there might be inability to pay. That's what happened in the Bowles case, which is in my outline. I'm just flying through these because we have a short time today. Let's talk about slats. I wanted to get to slats. We all love these things. During coronavirus, when I was home for over a year, my wife said all I did was walk around the house saying slat, slat, slat all day on my conference calls. I mean, this is what people love to do. But let's watch out for the risk. We know the reciprocal trust doctrine risk, right? You can't have the same trust. We all know that. Take a look at a case that's in my outline. If we're skipping ahead, a Reformation case, Jill Pierre St. Clair, where they had reciprocal slats and they went to court to reform the trust to say it was a scrivener's error. And one of those trusts should have had a 5x5 power. I don't know how you say it, like it should have had a 5x5 power. It didn't have it, you know, and a limited power of appointment. That should have been in there. The court said fine. And then they took it to the Kansas Supreme Court to get that confirmed. Well, why did they do that? Why did they go to the Kansas Supreme Court for this? Because of the Bosch case, a ruling from the highest court. That's fun to do, you know, be involved, be the drafting attorney in that one. But why did they do that instead of decanting? Because if it's a modification, then it could be retroactive for scrivener's error. It could be retroactive to date of inception. If you do a decanting, which you should do if you don't have any other choice, you might have released a 2036 right, which is a 2035 3-year pullback. So keep that in mind if you see this problem. Another issue overlooked with slats, grantor trusts typically at inception. Even after divorce, they're grantor trusts. So one of the hot topics right now is, well, what happens with divorce with these things? Is it marital property? So let's say you do one. A lot of people are like, oh, I have a brilliant idea. You have $20 million, right? Here's what we'll do. Listen to this. This is fantastic. You don't have enough money to do 2 slats. That's ridiculous. We'll do one. We'll use one person's complete exemption. That's fun. And then they get divorced. And then what happens? So the slat is the wife's property, let's say in this case, in the example. And then they divide up the rest. They divide up the other $10 million. That is not a great result. So one option is to have a marriage termination provision. And we use that a lot. So if you get divorced, you're out, right? But if you're not out, how do you deal with that divorce issue? Are you doing postnuptial agreements? I haven't been getting a lot of phone calls on the conflicted representation that you need to do a postnuptial agreement in that case. What if you do 2 slats, one goes up, one goes down? There's all kinds of marital property issues that are happening with these slats that I don't think are getting proper attention. By the way, I'm not just making this up. There's a case in my outline, the Dale case, which is out of Ohio, which is almost the exact facts that I told you. They did it was one of those 2012 gifts. They did a $5 million slat for one of the spouses. The court ruled that was separate property. And then they divided up the rest of the property, and I assume they sued the attorney. So, you have to watch out for these things. Remember with slats, there could be issues gift splitting. Have we seen that yet? People attempting to gift split off of slats. If you're an estate planning attorney, if you're not preparing the gift tax return, or you don't have somebody like Mark Scott, Kaufman Rossin doing the gift tax return, you're going to want to look at that thing. Because let's say they did one slat, they tried to gift split. We didn't want them to do that, and it probably doesn't work. If you're attempting to gift split a slat, there's probably a mistake, right? And hopefully you don't have a best interest standard. You have a resources standard, considering other resources, health, education, maintenance, and support. And the donee spouse has a lot of money, because otherwise you're not going to be able to sever it and say it's almost negligible, it's nothing. So gift splitting with slats is a problem. There's the Nelson versus Commissioner case, which really is a Wandry clause case where the taxpayer lost. but it's just because they didn't do the right laundry type clause. They tied it to an appraisal, and that's in my outline. I'm sort of catching up now. Oh, I'm looking at the time. I think I might be, am I a little over on my time? Okay. All those cases are in my outline. Take a look at them. I cited to the most important cases. Let's take a break, a 5-minute break, and we'll get back on schedule. Thank you, everyone.
Like the first 40 or 50 pages over and over.
You know, that's the problem.
You want me to do that in 20 minutes?
And I gave up 5 minutes. We're trying to do that.
I think we're still a good service, but.
I mean, I don't want to. I think that we All right, we're going to start back up to get back on track. We can close the back door if someone could help us with that. Thank you. Our next speaker is Charlotte Erdmann, speaking about tax procedures. She's one of our tax section's procedure experts and a rising star in the section, I might add. And she lives in a great town too. I really like Winter Park. I think that's a cool place. So that's always good. And of course, not surprising, University of Florida LLM in tax. So let us know a little bit about what's happening with tax procedure. Thank you.
All righty, I'm going to put that down because I am short. So I'm going to talk first about some innocent spouse cases. The Taxpayer First Act changed the scope of review of the tax court in innocent spouse cases to mostly the administrative record at the time of the IRS determination. Before the Taxpayer First Act, the tax court would review de novo, not based on the administrative record. In the case of Sutherland versus Commissioner, the petitioner was represented in the administrative proceeding, but counsel thought that the appeals officer was misapplying the equitable relief factors and that further working with the appeals officer would be unproductive. So they moved the case to tax court. The statute changed a year later, which shifts the scope of review from de novo to the administrative record. The language in the statute says effective date. The amendments may be made by this section shall apply to petitions or requests filed or pending on after the date of the enactment of this act. So the statutory language is a little bit ambiguous. Is it petitions or requests filed or pending? And it could mean petitions filed or pending or requests filed or pending. So basically the court said, hey, you know, the new Taxpayer First Act, you know, wasn't in effect at the time. And the Taxpayer First Act provision only applies for petitions filed after the enactment date. So they were able to bring in other information. It was reviewed de novo. It's kind of interesting, this new provision, because when we think about the administrative record, who is the one that's keeping the administrative record? The IRS. And in one of our coronavirus typos, I have that the administrative record can be screwed, not skewed, not technically incorrect, but just not as accurate, perhaps. So, you know, the IRS does not let recordings of telephonic meetings. The IRS basically has complete control of the narrative in the administrative record. And that's the only thing that the tax court is going to be looking back and reviewing. And I don't know if anyone's looked at a notice of determination after there's been a CDP hearing. Sometimes it's like, well, that's not what happened. So I imagine that that same kind of thing is going to be happening in these innocent spouse cases as we move forward. In Jacobson, this innocent spouse case involves how to weigh the factors, the equitable relief factors in innocent spouse cases. In this case, all of the positive factors are there except the actual knowledge factor. And both the tax court and the appeals court said, too bad, there's no innocent spouse relief. And so basically the taxpayer, challenged this and said, you guys are improperly weighing the equitable factor of knowledge. You shouldn't be doing that. And the court said, no, we're not improperly weighing a factor. It says, or the court said, because each of the factors for consideration was either neutral or favored relief, Jacobson claims the tax court must have weighed knowledge more heavily than the other factors. Nothing in the tax court opinion, however, suggests that it believed that knowledge of the embezzled funds necessarily precluded Jacobson from equitable relief or automatically outweighed the other factors for consideration. Although the 2013 regulations make clear that the knowledge is no longer necessarily a strong factor weighing against the relief, as Jacobson himself acknowledges in his brief, they do not prohibit the tax court from assigning more weight to petitioner's knowledge if such conclusion is supported by the totality of circumstances. And although knowledge no longer weighs heavily against relief, nothing in the statute or revenue procedures forecloses the decision maker from concluding that in light of all the facts and circumstances, knowledge of the understatement weighs heavily against granting equitable relief. Thus, there is no reason to believe that the tax court's decision was necessarily erroneous because only one of the non-exhaustive factors weighed against it. So they didn't weigh heavily against it, but they did, but that was okay because of the totality of circumstances. That's what we're kind of left with. Now, there was a similar 11th Circuit court case, Sleth or Sleeth, if I'm pronouncing that wrong. And basically, all the factors were positive except the knowledge factor. There was actually a neutral factor, and I'll get into that a little bit more. So the 11th Circuit also upheld the decision of the tax court to deny innocent spouse relief. The neutral factor was the economic hardship factor. And I think that this was really interesting because basically there was very little equity in a townhouse, and the taxpayer would have been destitute and leave her homeless and penniless. And that was only a neutral factor. The appeals officer, decided. So innocent spouse takeaways. If you have an innocent spouse case, consider another option like an offer in compromise, especially if there is an economic argument for it. And then make sure you document the administrative record really, really well. Make sure that the narrative isn't too swayed or skewed. Always argue against actual knowledge if you can. I'm going to talk now for a couple minutes about some CD cases, which are kind of interesting. And in Lander, the issue is, when is a taxpayer precluded from raising the underlying issue or the underlying tax liability because they had prior opportunity to dispute? Now, at issue in a bunch of these cases is the language of Code Section 6330 C2B, and that basically says that the person may also raise at the hearing challenges to the existence or amount of the underlying tax liability for any tax period, if the person did not receive any statutory notice of deficiency or did not otherwise have an opportunity to dispute such liability. So in this case, the parties stipulated to the receipt of the non-receipt of the notice of deficiency. And the issue is whether the action subsequent to the assessment created the prior opportunity to meet with appeals, and whether the opportunity to meet with appeals meant that the failure to receive the notice of deficiency no longer mattered for the purposes of that statute. And basically, the tax court held that the request for audit reconsideration was a prior opportunity, which precluded the right to raise the underlying liability. And that's kind of interesting because usually audit reconsideration does not usually give a path to tax court. So it kind of puts a taxpayer in a really interesting situation. The same issue came up in Patrick's Payroll Services versus Commissioner. In that case, the business owed about $1 million in back taxes. The IRS issued a 30-day letter and offered a chance to go to appeals to discuss the issue, and they did not go. So the IRS assessed the tax, commenced the collection action, including issuing a CDP notice of intent to levy. And this time they said, yep, let's go to appeals and discuss the underlying issue. And appeals said you had a chance and now it's too late. So they issued the notice of determination, they filed a tax court petition. And the first argument was, hey, we did not previously meet with appeals, and if we did, we would have not been able to get to tax court from there. And the tax court said it could not raise the merit since it had passed on its prior opportunity to go to appeals. The second argument, which I think is super duper interesting, is it kind of attacks the language of the statute itself, and basically is that the language must be read disjunctively, because the language is that they did not receive a notice of deficiency or did not otherwise have an opportunity to dispute such tax liability. And the court basically said, look, because you didn't raise this issue until the motion for reconsideration, we don't really need to consider that argument. But if we did, the answer would be no, because we do not believe that the word or creates a disjunction. And then it kind of goes into it. And I put part of the opinion in there. So that was kind of fun. Let's see, how much time do I got? A couple minutes. Okay, I'm going to skip a couple of the other CDP cases. I want to talk really quick about this interesting conversion and seizure case, Willis versus Boyd in the 8th Circuit Court of Appeals. The facts of this are pretty egregious. The IRS seized 364,000 $1 coins that were issued to commemorate US presidents. They were a coin collection in special boxes and special packaging, and an IRS employee removed each of the 364,000 coins and then deposited them in the bank for face value. So the taxpayer claimed that, well, these coins have significantly greater value, they're collector's items, and basically sued the government under the Federal Tort Claims Act for conversion. At the district court level, they won. Now, this wasn't really a sympathetic taxpayer, and if you read the district court case, you can kind of read more into that. But I thought it was very interesting, you know, the connection of sovereign immunity and the Federal Tort Claims Act. So under 28 USC 1346b1, the Federal Tort Claims Act waives sovereign immunity in suits seeking money damages against the federal government for injury or loss of property caused by the negligent or wrongful act or omission of any employee of the government while acting within the scope of his office or employment. There is what's called a discretionary function exemption, and it applies when government agents make decisions that are discretionary in nature. So the question becomes, was this discretionary in nature? And the court said, yes, it was totally discretionary in nature because the Internal Revenue Manual did not specifically instruct an agent to determine if the money was a collectible asset or not. The language of the Internal Revenue Manual states that domestic and foreign currency seized for forfeiture, except where it is held as a collectible asset, must be expeditiously counted, processed, and deposited. It doesn't say you have to determine if it is a collectible asset. And so basically, on appeals, they lost. And what's really interesting about this case is that what a lost opportunity it really was for the federal government, because they could have sold those coins and collected a lot more to be applied to the tax liability. I think the case might have been a little bit different if the Internal Revenue Manual had specifically stated that, you know, the IRS personnel must make such a determination of is something, especially currency, a collectible asset. But I mean, that's just my reading of it. But thank you so much.
Thank you, Charlotte. Thank you, Charlotte. Another great presentation. Just some quick housekeeping items. The family hospitality suite is open till 2 p.m. So if your family needs something to do right now, run on over to that. Or if you're a little hungry yourself, why not go over there? And also, just on my countdown, I'm starting an hour and a half until mimosas and bingo with Michael Lampert, ethics bingo. And remember, only live attendees could win prizes. Not to bias, but only live attendees. Our next speaker, Lowell Walters with Carlton Fields. He's of counsel with them in the Tampa office. He does employee benefits work and an LLM from Miami Law, right, in tax. So great to see you and looking forward to your presentation.
Thank you very much. Hello, everyone. Yes, the focus of my practice is employer-provided retirement plans and group health insurance. But I know that's not the focus of your practice. So I'm going to be giving an update, an employee benefits update, really things that I think would be of interest to general tax practitioners, business counsel, corporate counsel. The first thing I want to talk about, section 1.1 of my outline, is a potential opportunity some of your clients might have to convert after-tax dollars to pre-tax. Back in 2020, anybody who was diagnosed with COVID or their income was negatively impacted by COVID, reduced hours at work, reduced income, they could withdraw up to $100,000 from their IRA or 401k. That was in 2020. If they did that, they now have 3 years to actually pay that back. So if their financial situation has turned around or turns around in the next few years, they can put that money back. What's more is that even if they withdrew that money from a 401k plan, they don't have to return it to the same 401k plan. If they change jobs, they might be able to put it in the new employer's 401k plan, or they could put that money into an IRA. And that's notable because IRAs often have more flexible investment options. So if you have clients that potentially want to invest in Bitcoin, purchase real estate, what have you, they may be able to do that with pre-tax dollars. Let's see. Next, I want to skip to section 1.3. Most businesses, they divide their employees into 2 categories, full-time and part-time. And under ERISA, a part-time employee is someone who doesn't work 1,000 hours. 1,000 hours is really less than 20 hours a week, so it doesn't take much to breach that. However, there is now a new category, long-term part-time employees. If you're advising a company, they need to start tracking their part-time employees. If those that work at least 500 hours a year for 3 consecutive years must be allowed to salary defer into the employer's 401k plan. Now, 500 hours a year works out to less than 10 hours a week. So employees averaging 10 hours a week or more, but less than 1,000 hours, will have to start being allowed to salary defer. Now, the employers don't have to look back at what these employees worked in 2020, 2019. It's prospective only. So they need to start tracking now. And presumably, I think it's 2024 will be the first year these individuals need to be allowed to salary defer. Now, shifting over even further into investments, there's been a couple of interesting rulings I want to talk about investment litigation. And investment litigation and retirement plans follows a pretty similar path, all right? The employee or the class action of employees and former employees say, you let me select from this group of investments when this group of investments would have been better. It would have been lower fees, would have been better returns. So now those losses, you need to make up for them in my account. What's interesting here is that it helped that the employee didn't read the information that the employer provided. And it made me think, how many of my clients don't read the information that I provide? How many of your clients don't read the information that you provide? And it's not exactly the same. This is not like a slippery slope situation, but it was kind of interesting because the employer's main defense was 5 years ago, we provided you all the information about our investment options and about the fees. So you could have known it right there 5 years ago. Plus, we know from computer records that you accessed the website and clicked on the pages that contained all of this information. So you knew everything you needed to know 5 years ago. And there's a ERISA statute of limitations. You have to bring suit within 3 years of actual knowledge. So this suit is time barred. The employee's defense, well, I got it, but I didn't read it. And maybe I did click on those web pages, but there's really a lot of information on there. I'm not really sure what I saw and didn't see. The court said that since the statute of limitations requires actual knowledge, receipt of the information is not the same as actually knowing that there was a problem. So they're allowing this participant's claim, the class action claim, to continue. So I thought that was very, very interesting. Then the DOL issued a couple of rulings allowing for more flexibility on investments. In one that was issued last year in June, the DOL was asked about allowing private equity fund investment. The idea is that most retirement plans will say, here's a bunch of investments you can use and put some money in here and some money in there, or you can put all of your money in this one investment and it'll automatically be invested, a portion in bonds, a portion in high growth capital stocks, and a portion in mid growth, and it'll be all balanced out. They wanted to be able to have a portion of that invested in private equity. And the Department of Labor said, well, private equity is really for more sophisticated investors. But if you think that this is appropriate for your pool of employees, yes, you can allow private equity investment through your 401k plan. Well, let's see. Fast forward to just this past January. And of course, there's a class action lawsuit. Actually, against the same company that the last lawsuit I talked about was against. But it pretty much said, you allowed private equity and hedge funds to be used in this balanced fund. And the returns were lower than in all these other funds you could have used. And our fees were higher. In fact, they said the fees were 2 to 3 times higher. The court looked at this and they said, we dismiss that claim because we're not going to let hindsight govern things. No one really knows how an investment is going to turn out. The question is whether you did your due diligence at the time you allowed these investments. So they dismissed the claims and they said to the plaintiffs, if you want, you can do some of your own digging and bring more specific claims, what the employer did wrong when they initially selected those investments, not relying on hindsight, and then we'll entertain that case. Another investment-related ruling from the Department of Labor also happened last October. The question was, can 401k plans offer specific investment offerings based on social issues, like offering mutual funds that focus on green companies or minority-owned businesses? The response from the Department of Labor was, it was not an absolute no, but it was in essence a no. It was financial factors have to be primary. This is not really your money. This is money you're investing for your employees or your employees are investing for their future. And it needs to be based on investment factors only. They said if there's a tie, you could use this as a tiebreaker, but the DOL said they would be very dubious, very suspicious of any claims that there was a tie. Now moving on to some, welfare plan news I'm now on section 3.1. Our employers are having to offer their employees free COBRA coverage. If you're advising a company that is more than 20 employees, they have to offer COBRA with their medical insurance. And employees must be offered, former employees or employees who lost their group health insurance due to a reduction in hours must be told that they're entitled to free COBRA between last April and this upcoming September. And it's not just employees who lost their health coverage during that term. Even employees who lost their coverage earlier and the COBRA could have extended into that term, your clients are having to notify this group that, hey, by the way, if you have expenses, if you want coverage, let us know. We'll give you free COBRA coverage. The companies then are able to take a deduction for that on their 941. All right, so potentially I may have questions for you about that. They take a deduction for this free COBRA. What the employer would have gotten in COBRA premiums, the employer gets to deduct that on their 941. If the deduction winds up being greater than what they're paying on their 941, they can request a refund. It's very similar to the tax credits they got for keeping employees on paid leave back in 2020. Not exactly the same, but very similar to that. All right. I'm going to skip over 3.2 because it's just too technical for me to cover in the time allotted, but a lot of employers are trying to provide its employees with incentives to make sure they get vaccinated. So you may want to look at my section 3.2 while I move on to 3.3 so we can talk about sex. That's always fun. All right. This past year, things have really progressed towards sexual orientation becoming a protected class under sexual discrimination. There was a Supreme Court case last June that really is paving the way. It actually was 3 cases combined into one. We had a governmental entity firing an employee for being gay, a private company firing an employee for being gay, and a private company firing an employee for being transgender. And it just so happened they were in transition between genders. I don't know if that really matters or not. But in each of those cases, the Supreme Court said that firing was a violation of Title VII. It was a form of sex discrimination. Now, the Department of Health and Human Services, about a year later, this past May, issued a statement saying the Affordable Care Act has its own non-discrimination requirements for group health plans, basically saying group health insurance cannot discriminate on the basis of sex. And HHS says they're going to interpret that in accordance with that Supreme Court case, which has made most of us think that what they're getting at is potential lawsuits or potential claims if group health insurance doesn't cover transgender surgeries. Lawsuits will probably determine whether that's really the case or not. But let me just mention the Special Affordable Care Act provision doesn't apply to all group health plans, all right? But it generally does apply to group health plans offered by entities that work in the medical insurance space. So we're talking about your hospitals, your doctor groups that are providing health insurance to their own employees. It's almost universally going to apply to them. So I want to keep up on that. Next, I want to move on to HIPAA, section 3.4. HIPAA cases are just a lot of them are just really very interesting. Here's one I want to talk about mainly because it involves a major hospital in Florida, the Jackson Health System in Miami, penalized more than $2 million. All right, it turned out they determined that over 1,500 patient records were lost and either not reported or reported late. They found that 2 employees not only improperly accessed patient records, but actually shared them with news reporters. And I understand, I think there's a lot of music stars and TV stars in Miami. I think that this mainly involved sports people, Miami Marlins, Miami Dolphins, maybe some visiting teams. But apparently, one employee accessed over 24,000 medical records that they had no reason to access and sold them. And one of the reporters that received this information worked for ESPN, tweeted it out. All right. It was an NFL player that was involved. They were negotiating a contract, getting the fine tuning done on a deal worth $60 million. And after the tweet came out, within like 3 hours, the NFL team withdrew their offer. So that all led to a penalty of over $2 million. All right. Contrast that to, I find an interesting case about a small medical practice, a very small dental practice in Texas. They were getting very bad Yelp reviews. Yelpers saying, they oversold me. They should have put this through insurance. Turned out it was denied. They didn't tell me all these things. And you might have seen restaurant reviews where someone criticizes the restaurant and the restaurant actually responds, we had a bad night that night, please come back. We've hired more servers, the service will be better, that kind of thing. The dental practice started responding. It was things like, we showed you your x-rays, we knew you needed to remove your molars. We did this, you knew we needed, this was the plan. Well, the Yelp reviewers were using their actual names, and I think Yelp likes you to use your actual names. The medical practice response had their treatment plan in there. Those two matched together is protected health information. So I think because of the size of the practice, they were only dinged with about a $10,000 penalty. And I did go online. I was hoping to catch what the reviews actually said so I could have snapshotted it. But at this point, they've all been changed to say, due to HIPAA, we cannot respond. And there's still, all the complaints are still there, but the dental response is always, due to HIPAA, we cannot respond. So that was certainly very, very interesting. And the last item I want to talk about is just a preview of something for next year. There's a patient protections going into place starting in 2022, and this is part of the Consolidated Appropriations Act. And I think one of the nice changes, a lot of times your doctor, who of course is in network, that's why you chose them, they're going to do surgery on you and they have you go to a surgical center, and you know the surgical center is in network, but it turns out one of the other doctors who's helping out in there is out of network. My experience, it's usually the anesthesiologist who kind of throws the monkey wrench into things. Well, apparently under this rule, that anesthesiologist or out-of-network provider cannot balance bill you, and you won't be able to be charged any more than you would if they were all in network. So that'll be a nice cost savings for all of us going into 2022. Thank you very much.
Thank you, Lowell. Great presentation. Our next speaker is Thomas Treece. He's going to be presenting the partnership tax update. He's an associate with Dunwoody, White, and Landon in the Naples office, where I'm planning to have possibly one of my meetings. So we're going to have to talk a little bit about that. He got his law school. He went to Florida State and an LLM in tax from Miami. So a little bit of a rivalry there. And he's been a very active member of the tax section for a number of years now, and look forward to his presentation. Thank you, Thomas.
Okay. Good morning. It's an honor to speak at Ullman. I prepared an outline that shared and circulated. I hope you find the materials beneficial. I'm going to try and highlight some of the, the items that might be useful in your day-to-day practice. The first topic is carried interest in Section 1061. For fund managers, they have to be aware of Section 1061, which extends the holding period to qualify for long-term capital gain treatment with respect to carried interest from 1 year to 3 years. Otherwise, the gain is subject to recharacterization as a short-term capital gain. This rule applies to distributions made by the partnership to the fund manager, as well as dispositions by a fund manager of a carried interest. There is an exception if the fund manager contributed capital to the partnership rather than just services. That is, the portion of gain representing a return of the fund manager's capital is not subject to recharacterization under Section 1061. It's important to note that this exception applies even if the fund manager made a capital contribution using borrowed funds lent by another partner or the partnership or a person related there to either, so long as the loan is structured as recourse. Fund managers also need to be aware of Section 1061D, which deals with transfers of a carried interest to a related person. A related person means a family member within the meaning of Section 318 and those attribution rules, or a person who performed a service within the past 3 years for the same trade or business as the fund manager. The prior proposed regs made such a transfer taxable as a short-term capital gain, even if the transfer was otherwise a non-recognition event. The final regs clarify that 1061D does not accelerate gain. It only applies to transfers in which long-term capital gain otherwise is recognized under the code. As such, it does not apply to non-recognition events such as contributions to a partnership or gift transfers. If 1061 applies, you calculate the amount recharacterized as short-term capital gain by determining how much net long-term capital gain would be triggered if the partnership sold all of its assets for fair market value, the ones that have been held for 3 years or less. And then the partnership allocates to the transferor his or her distributive share of that short-term capital gain. An update on 199 Cap A, as you are familiar, it provides a deduction of up to 20% against qualified business income items under the code. The new final regs address treatment of previously disallowed losses in the computation of QBI. They deal with how previously disallowed losses are factored in when computing QBI, what types of disallowed losses are taken into account, as well as the treatment of partially disallowed losses. And those final regs confirm that in computing QBI, previously disallowed losses in the taxable year are generally taken into account, except such losses incurred in years ending before 2018. Any previously disallowed losses are treated as incurred by a separate trade or business in the year they are taken into account, rather than by the trade or business that actually generated such losses in a prior year. Whether such disallowed losses are attributable to a trade or business is determined in the taxable year that loss is incurred. With respect to the types of disallowed losses that are taken into account, the prior regs provided an explicit list, but the new final regs clarify this list is not exhaustive. It also explicitly includes Section 461L, which deals with the limitation on excess business losses. An excess business loss is the amount by which the total deductions that are attributable to all the taxpayers' trade or businesses exceed the taxpayer's gross income and gains attributable to those trade or businesses, with an additional, let's see here, $250,000 added to that calculation for a single filer. 461L was amended under the CARES Act for taxable years after 2020 and before 2026, such that any excess loss of a taxpayer for the taxable year is disallowed, and such excess losses that are disallowed are treated as an NOL carryover to the following taxable year. With respect to the treatment of partial disallowance, only the portion of the allowed loss that is attributable to QBI will be considered in determining QBI from a trade or business in the year the loss is incurred. And the portion of the allowed loss that is attributable to QBI equals the total amount of allowed loss multiplied by a fraction, the numerator of which is the total loss incurred during the taxable year that is attributable to QBI, the denominator of which is the amount of total loss during the taxable year. And the final regs have an example I'd like to share. An unmarried person is a 50% owner of an LLC, an entity classified as a partnership for federal income tax purposes. In 2018, A's allocable share of loss from LLC is $100,000, of which $80,000 is negative QBI. Under 465, $60,000 of the allocable loss is allowed in determining A's taxable income. A has no other previously disallowed losses from 2018 or a prior year. Because 80% of A's allocable loss is attributable to QBI, 80,000 of the 100,000, A will reduce the amount A takes into account in determining QBI proportionately. Thus, A will include 48,000 of the allowed loss and negative QBI in determining A's 199 Cap A deduction, and the remaining 32,000 in negative QBI is treated as negative QBI from a separate trade or business for purposes of computing the 199 Cap A deduction and the year of the loss is actually taken into account. There's Also, some updates in regards to partnership reporting, the details of which are in your outline materials. They deal with tracking capital accounts and also partnership reporting with respect to international tax items. Where a non-US person sells an interest in a partnership that's engaged in a US trade or business, this new regulation or final regulation deals with how the sale is taxed and what portion of gain or loss is treated as effectively connected income. To determine that, there's a deemed sale of partnership assets test of the underlying assets of the partnership. And you look at the amount that would have been considered ECI in a deemed sale context, and then you allocate to the partner her distributive share of ECI. And the IRS recognized there are some sourcing difficulties in the context of a deemed sale, such as whether the deemed sale is attributable to a US office or whether a foreign office materially participated in the sale. So these regs attempt to add clarity with respect to the treatment of a deemed sale. And they provide that all gain or loss shall be treated as attributable to a US office if there is one, but only with respect to personal property held by the partnership. They provide additional sourcing rules with respect to deemed sales of inventory, intangibles, and depreciable property. If the partnership does not maintain a US office, neither the US office attribution nor the additional sourcing rules will apply. And these final regs continue the 10-year rule exception, which applies if the asset in question produced no ECI in the 10 years leading up to the disposition, and such asset has not been used in the conduct of a US trade or business. An additional set of final regs from 2020 also deal with withholding obligations incident to such transfers by a foreign person of a US partnership interest. It requires a transfer to withhold 10% of the amount realized on the sale under section 1446, unless certain exceptions apply. My final topic is an update on section 163J, which provides a limitation on the amount of business interest expense deductible by a partnership. The computation of BIE is provided here. It's the sum of the taxpayer's business interest income, 30% of the taxpayer's ATI, plus the taxpayer's floor plan financing interest expense. There was an amendment to 163J under the CARES Act for years beginning in 2019 or 2020. And the computation of the amount of BIE deductible is 50% of ATI rather than the tip standard 30% for the taxable year. But the taxpayer can elect the 30% treatment. Under the final regs of July of 2020, there was some guidance on what qualifies as interest, and guaranteed payments for the use of capital were removed from that definition. However, there's an anti-avoidance rule that can pull or classify such a guaranteed payment as interest and interest payment. And that anti-avoidance rule applies if the guaranteed payment is economically equivalent to interest, and a principal purpose of structuring the transaction as a guaranteed payment for capital use is to avoid interest. An example will help for this, which I pulled from the final regs. And we can go through that example here. So A, B, and C are equal partners in ABC partnership. ABC is considering acquiring an additional loan from a third party to expand its business operations. However, the partnership already has significant debt and interest expense. So for the purpose of reducing the amount of additional interest that the partnership would otherwise incur by borrowing, a partner agrees to make an additional contribution to the partnership for use in its business operations, and that will be structured as an exchange for guaranteed payments for the use of capital. So the guaranteed payment is deductible by the partnership. It's incurred by the partnership in a transaction in which the partnership secures the use of funds for a period of time. So it looks more like debt rather than equity, those characteristics. Therefore, the payment is economically equivalent under this example to interest that the partnership would have incurred on an additional loan from a third-party lender. And it notes that a principal purpose of making the contribution in exchange for guaranteed payment was to reduce the amount incurred by the partnership that otherwise would, of course, be treated as an interest expense. Therefore, for purposes of 163J, the guaranteed payment is reclassified as an interest payment, and the interest, deductible by the partnership and as interest income received by the partner, which means that more business interest expense is subject to the 163J limitation. I had one last slide, but it looks like in the interest of time, I will go ahead and reference the materials for the final slide. Thank you.
Great job. Don't forget your phone.
Yeah.
So I'm actually going to introduce one of our sponsors at this point in time. One of the things we made available to our sponsors, if they were here and in person, I want them to be able to take a quick word. So John is here. John Harris is a long-term sponsor and a friend. And he's managing director of Coral Gables Trust, and he's going to say a few words and also introduce our next speaker.
Thank you so much, Mark. It's great to see everybody here. Good morning. As Mark said, I'm John Harris. I'm managing director with Coral Gables Trust. My coworker that's here is Richard DiNapoli. He's our chief trust officer. He's not in the room right now, but he's at the conference. So I'm sure we'll all see each other later. I wanted to first and foremost say how very thankful Coral Gables Trust is to be a very long-standing sponsor of the tax section, and how wonderful it is to be back at Amelia. So this is wonderful. Now I'd like to say a few brief words about Coral Gables Trust. At over $2 billion, Coral Gables Trust is now the largest independent trust and wealth management firm with its headquarters in South Florida. Our board, our shareholders, our management team are all located in Florida. Our committees meet in Florida. Our decisions are made here. This allows us to be highly responsive to clients and flexible in terms of solutions to them. And we do all of this at a high level through 4 full service offices, downtown Coral Gables, downtown Fort Lauderdale on Las Olas, downtown West Palm we're moving into the city place building. We've already signed a lease, so we're expanding there. And then downtown Boca Raton off of Glades. Again, we do everything at a very high level: trust, wealth management, financial planning services. We do this at low minimums and reasonable fees. And some areas that have been where we're seeing a lot of work are delegated and directed trust product here in Florida, where we are corporate trustee. We provide all the administrative services. We allow a third-party investment management firm, RIA, financial advisor with the likes of UBS, Morgan Stanley, continue to manage the funds. That's seeing a tremendous amount of work there. And then we also are seeing a great deal of work in terms of domestications. And I mean, not only offshore families that are bringing wealth to the United States, but of course, we're seeing families from the Northeast US and the Western part of the United States moving here. And we many times are part of tax efficient structures utilizing our fiduciary and trust powers. So that are some areas that are working now. I have the great opportunity of introducing the next speaker. So without further ado, I'm introducing Karen Lapekas. I'll put my glasses on, my eyes are going. Karen is board certified in tax and specializes in tax controversy and litigation. When she is not defending clients against the IRS or the Department of Justice, she enjoys teaching tax procedure at the University of Miami. She does all this while attending the world's greatest 24/7 master's class on happiness, love, and laughter, taught by her precious 2-year-old daughter, Rhea. So, Karen?
Thanks, John. It's always an honor to speak at the Ullman Year in Review, because I really do credit Professor Ullman for having a career or even wanting a career in tax controversy. There's a long story, a very serendipitous story about my interactions with him, but one point is I had an interview with the IRS in March of 2009 in Miami, and before I drove down to Miami, I went into Professor Ullman's office and I said, can you tell me what an IRS attorney does? Because I'm interviewing for this position and I have no idea what it is. So he helped me prepare for the interview. That afternoon, I drove down to Miami and stayed at the cheapest hotel I can find on the beach, which happened to be North Miami Beach. The next morning, before I went to the interview, I went out on that beach, prayed like crazy for a miracle so that I could get a job. That also happens to be the same beach where I think we're all praying for a miracle, because that was right next to where the Champlain Towers are right now. So that hit me this morning when I was thinking about the moment on the beach. But anyways, I believe in good people like Professor Ullman, I believe in miracles, and I know we're all holding out for one. Anyways, moving on to FBAR litigation. I told Mark that I could do this very briefly because it's really just 5 minutes of bad news. It really is. Let's start with the good news. If there's a non-willful penalty, which if you got the non-willful penalty, you ought to be celebrating. I mean, really, the facts are extremely good for the IRS only to go after the non-willful penalty. But several courts, and now I think we're all in agreement, that the non-willful penalty only applies per year and not against every single account that you held for which you did not report on an FBAR. So $10,000 a year, that's just pay it and move on. So that's the good news. The bad news is not all courts generally agree that the willful standard is objectively, were you objectively reckless? It's not whether you believed it, whether you had no idea about the FBAR, but really, should you have known? And that's, was your conduct reckless? In my opinion, it's whether the court really believes you or not. And if they don't want to come out and call you a liar, they say, well, objectively, you should have known. And that was with the case with my client. I was hoping I was going to come here today and be able to tell you some good news about a case that I won, but we just lost a case. I just lost a case a month ago in the court on the objectively reckless standard. Unfortunately, my client was a CPA. He had been for 60 years. But he went and studied accounting and became a CPA before the Bank Secrecy Act was passed. So this was not a topic he learned about. And he, all his clients were local. They didn't have foreign bank accounts. He had never filed an FBAR in his entire career. But the court didn't buy it. And especially he'd filed thousands of returns over the year with, lots of Schedule Bs that ask people whether they have foreign bank accounts that refer to the FBAR. And that's consistent with all the cases. Though in the past, you have fewer courts in McBride and Williams. These are the two I referred to in my materials up front. The court said, look, if you filed a return and you saw, you signed it under penalties of perjury, you marked on Schedule B that you didn't have foreign accounts, that's it. If you didn't file the FBAR, you were willful. Later on, we got good news and the court said, wait, that's not enough. Just because you marked it no on Schedule B, it doesn't mean you were willful. And that's what Judge Bloom said in the Schwartzbaum case. She's the same judge I had the trial before in Kronowitz a few months ago. She said, even though you filed that Schedule B, that's not enough. However, in the end, after trial, essentially that's enough. If you file a tax return and you see that Schedule B and you say no foreign bank accounts, the court is going to find that if you didn't file an FBAR, it was willful. There's some luck at summary judgment. That's what, we had some luck at summary judgment as well, because the court says, we're not going to judge one's credibility on summary judgment. and we're not going to weigh facts on summary judgment. But when you have an objectively reckless standard and go to trial, that's what they're going to do anyway. So a lot of courts will just dispose of this at summary judgment. Some don't, like in the Southern District of Florida. The bad cases, all came out of, several of them that came out of people that withdrew from the OVDP. And I'm sure that's a decision they regretted a lot. You're going to see a lot of these cases, they withdrew. Why don't we see good ones? I believe because they settle. And you're going to see that because, if you go in PACER, you're going to see that the history of the case, and there's just going to be a stipulation. And that's a settlement. That's what happened. I had a case that the facts were extremely good, was ready to go to trial. But when it came down to it, we were able to settle for less than what they might have paid me in attorney's fees. So the settlement mattered. But unfortunately, we don't get those good cases to refer to. Those good facts don't come out. An interesting case I saw is that the IRS can go after a willful penalty against one spouse and the non-willful against another. So that's something you might consider when doing an offshore voluntary practice. If you enter into that, whether it should be joint, because you could essentially get greater penalties if they go after each spouse separately, one for willful, one for non-willful. Another part that might be of consideration is a jury trial, where there has been some luck for some periods, the taxpayer went before a jury. So you might have more luck if you go before a jury. And certainly one of the worst facts, in addition to filing a return where you say on the Schedule B that you didn't have a foreign bank account, is if you had income that you didn't report. That's another extremely egregious factor. Another point, one more thing, FBAR penalties are not taxes for purposes of the floor rule. So technically you could pay $1,000, pay whatever you want, and sue for a refund. It's not suing for a refund. It's actually suing for arguing that the FBAR penalty was an illegal exaction. So that's a way to get into court if for some reason you don't want to wait and see if the Department of Justice sues you first. And that's it. So thank you.
I was told that next year we should have a countdown clock, and I totally agree. We will have a countdown clock for mimosas next year. That's going to be in about 45 minutes. Right now, we're taking a break. All right, we're gonna start back up. If someone could close the door in the back. Thank you. Our next speaker is French Brown, shareholder with Dean Mead, very active tax section member for a number of years now, and he's our resident expert in state and local tax. Not surprisingly, cheer. Please save your applause for the end, right? So everyone gets equal applause. He used to work for the Florida Department of Revenue, and it goes without saying that he's been deeply involved with all major legislation moving through the Florida Capitol, and he's gonna let us know a little bit about that.
Thank you, Mark. And who's ready for a little sprinkle of salt today? I do want to start off a little bit and thank Mark for his presentation earlier, talking about House Bill 625, attorney compensation, and Senate Bill 1070, which are two that aren't included on this presentation because they are focused on state and local tax issues. But thank you, Mark. A little bit of the backstory on House Bill 625, the attorney compensation bill. The original proposal, which had been a proposal for years, was to completely do away with the presumption of reasonableness of the statutory fees. And that was the direction the legislature was going through a lot of advocacy and work. A number of individuals that's why we kind of got to that resulting, these new disclosures, is to make sure that clients are well informed as they're entering into representation, but then still to retain that presumed presumption of reasonableness in the statute was really important. Just a little bit lay of the land. I'm sure everybody knows who this gentleman on the left side of the screen is, Governor Ron DeSantis, most popular governor in the nation right now. We also have the Senate President Wilton Simpson. He is an egg farmer out of Trilby, Florida, just east of Tampa, and House Speaker Chris Sprouse, who is an attorney out of the Pinellas County area. Just a little bit, everybody in this room, I'm sure we're all numbers people, just a little bit of information. So this is a historical look to kind of show how many bills have been passed, how many bills have been approved every year. In 2021 regular session, there were just under 3,100 bills filed to be considered. Out of that, only 275 ultimately passed. 275 is a low number, but it's significantly higher. The last couple of years, we had 200, 197, and 210 for the last 3 years. So 275 is a bit jump up. Another thing just to note, and it got cut off on the screen here, but hopefully the folks online can see it. The budget that was passed this year in Florida that went into effect yesterday, it was a $101.5 billion budget. It's the largest budget that's ever been approved by the state of Florida, but still significantly larger than a number of other states. All right, so one thing about this session, I think I can honestly say that in the area of state and local tax, there was probably more legislation passed this year, more substantial legislation passed this year than that has been in the last 4 decades. It really was a very significant year. Florida finally, after a couple years of trying, we finally passed remote sellers, economic nexus, and marketplace facilitators language. Those were contained in Senate Bill 50. It was a very large bill. It was passed early in session, sent to the governor early, and the governor did end up signing it. Hopefully anybody in the state and local tax realm have really been following these things across the various states since the Wayfair decision, since the South Dakota Wayfair decision. But some of the key points for the Florida bill is that it only looks at $100,000 in taxable retail sales in the prior calendar year. There's no transaction threshold. Ultimately in Florida, we decided, it doesn't matter if you have 200 $5 transactions. Let's really go after the individuals that are having substantial number of sales over $100,000. There's a couple different little carve outs, but it does focus specifically on retail sales. If you've done work in other states, some states include gross sales, which would mean they may be resales, sales for resale that are exempt that you wouldn't even be paying Florida or that state's tax on, but you'd still have to register and remit. That's not the case in Florida. It does remove the local sales tax exemption for mail order sales. It has longstanding been in Florida statutes. And then it obviously clarifies the registration, collection, or remittance requirements. It does provide for marketplace sellers. There's a couple provisions related to marketplace sellers that go into effect July 1. There's some more that go into effect April 1 of next year, including a large seller exception, letting large sellers carve themselves out and essentially directly remit to the Department of Revenue. But otherwise, most any other marketplace provider, so your Amazon.coms, your Walmart.coms, those types of online marketplaces, they're going to now be responsible for collecting and remitting the sales tax on every transaction that goes through their marketplace, and those individual sellers aren't going to be responsible for that. The bill also includes some safe harbors and things for businesses. It has direction of the Department of Revenue that once they start getting new information, they can't use that to go after businesses in the past. So if you run into those types of issues, please make sure to dive into that bill. It's a long, substantial bill. In addition to all the economic nexus stuff, one thing that was thankfully finally being able to put in the bill, something that a number of folks have been working on for a number of years, is we finally repealed Florida's bracket system. So for those that weren't aware, Florida has always had a system when you calculate your sales tax, when you get out to that fraction of a penny, that third decimal point, the bracket system almost always makes you automatically round that up. I'm sure any of us can think of the movie Office Space, the good old trick of, let's siphon off that fraction of a penny. That's what the state of Florida was doing to everybody pretty much since inception. Moving away from the bracket system, Florida is now going to be on traditional rounding. So if the third digit is a 4 or lower, you round down. If it's 5 or higher, you round up, just like all of us learned in grade school. That did go into effect July 1, but the legislature put in place a grace period through the end of September for businesses to make sure that they can reprogram their systems, but be aware of that. In addition to all the great things like the fairness and having remote online sellers now have to register and collect the Florida tax, this bill really couldn't have been any better for Florida businesses, especially as we're clawing our way out of this pandemic. So it did two other huge things for Florida businesses. Number one, Florida businesses were facing a $700+ million reemployment tax rate increase effective January 1, 2021. And that was just due solely to the fact that the pandemic pretty much drained the state of Florida's unemployment compensation trust fund. Pre-pandemic, we were up over $4 billion. It got drained down to about $500 million. And so it was an automatic adjustment that was going to result in a lot of Florida employers paying a whole lot more of reemployment tax, $700 million more this year, probably double or triple that next year was what the projection was. So, I mean, it was a significant amount of money. Ultimately, what this bill did was it used the projected new revenues coming in from the online, the remote, and the marketplace sales to the legislature directed the Department of Revenue to recalculate rates, freeze rates where they were pre-pandemic, and then backfill that unemployment compensation trust fund to get it back up over $4 billion. So that's huge savings. Just to note, in discussions with the Department of Revenue, so last week, I want to say they had over, let's see, I got the notes right here. But last week they had already issued over 11,000 refunds, totaling more than $290 million of reemployment taxes for people that had paid early before this bill went into effect and was signed, because that people had paid before on the higher rates. The Department of Revenue is also expecting another total of about $460 million in refunds to get cut once they're finally finished providing those refunds related to that change. And then in addition, if that wasn't great enough, once the bill provided that once the unemployment compensation trust fund got rebuilt to $4 billion, then Florida was going to have an automatic and the most substantial ever cut in Florida's sales tax on commercial leases, or the business rent tax. So if you recall, Florida it's the only state in the nation that has a sales tax on commercial leases. It catches a lot of people, a lot of businesses flat-footed. But over time, the legislature, over the last 5 years or so, the legislature has whittled that down at the state rate from 6 to 5.5%. When this provision kicks in, it's going to drop it from 5.5 to 2.0 at the state rate. It's estimated to save businesses $1.2 billion annually. It's going to save tenants $1.2 billion annually once this goes into effect. Now you'll still have your local rate. So if you have a 0.5% or 1% or 1.5% at the local level, that'll be on top of the 2%. But just note that when this kicks in, it's going to be significant savings for tenants. Big bill. And then in addition to that, we have our annual tax package bill, which the legislature always does. This year was no different. It was a substantial bill. It was very large. It had dozens of items in it. I'm not going to go through all of them in detail, but all of them are included on the slides. That bill in and of itself had an estimated savings of about $169 million in the state fiscal year that started yesterday. So we have our traditional sales tax, back to school holiday, our traditional disaster preparedness holiday that occurred the end of May and June. We have a brand new, they've actually called it Freedom Week that started yesterday. So we're currently in Freedom Week right now, freedom from sales tax. It's not for all things sales tax, but it's very limited things, but it's your outdoor sporting equipment and towables behind boats and sunscreen and all those various types of things. And then in addition, it also includes admissions. So sporting events, cultural events, music concerts, all those various things. You can buy those tickets this week. And just say, for example, for the concerts, the concert doesn't have to be held this week as long as the concert is held by the end of this calendar year. But if you buy your tickets this week, you can get them sales tax free. So take a look at that. The Department of Revenue has a tip and emergency rules out for that. It's interesting, and it's a brand new sales tax holiday that everybody's kind of working through right now to get administered. So, like I said, I'm just going to touch on a couple of the other things that were included in this tax bill, in this tax package. New sales tax exemption for assisted independent living, so like bed rails and those types of things. Those are now going to be exempt in Florida. That's brand new. Couple things that the Department of Revenue proposed and got passed. And some of them are a little significant just to be aware of. The statute now no longer has a mandatory in-person audit requirement. So the statute historically said that the Department of Revenue had to come to your physical location to look through your books and records. They got legislation in this post-COVID world that said if you have electronic records, you have to provide them to the department electronically, and they removed the requirement that they have to go visit you in person. So be aware of that. Also a provision that allows the Department of Revenue to aggregate collection reporting periods when they're determining criminal offenses. So be aware of that if you have any issues that run into those, any clients that run into those types of issues. One thing, so last year in 2021, the legislature passed, essentially it was a very interesting law that would have said that if a nonprofit hospital wasn't providing enough community benefit as what they were receiving in property taxes, they were going to get a reduction of their property tax exemption. Don't worry about that anymore because this bill repealed that. So this bill repealed it before that even got kicked into place. That was a delayed effective date, but the bill that was passed this year did away with that. As you can see there, there's changes and increases to the property tax exemptions for affordable housing. There's changes related to educational property and things like that to try to clarify a number of little issues. Clarifications on how property damage by calamities are going to be treated in the future. So a lot of property tax related changes if you practice in that area. So please be sure to take a look at that. The annual tax package bill also included a new corporate income tax credit for internships. So if you employ interns, you can get a $2,000 credit per intern. Now that's going to be capped at $10,000 a year. So it's not, the most savings, but still, if you're C Corp paying Florida corporate income tax, be aware of that if you have clients that employ interns. On this slide, I think what I'll mention is the third bullet so there is a provision in this bill that tries to clarify, some may not be aware, but parts of LIBOR are going to be sunsetting at the end of this calendar year. This clarification they added clarification to the documentary stamp tax to say that if you have to essentially redo a document to change the reference to the interest calculations effectively for this type of issue, then that's not going to be a new document that would be subject to the documentary stamp tax. So if you run into those types of issues in the future after LIBOR goes away, take a look at that and be aware. Now, this is an interesting bill. Anybody that's heard kind of my different legislative updates over the years, so many things in the Florida legislature passes are business friendly. This is one that went a little bit in the opposite direction, but Florida's annual corporate piggyback bill. So they did adopt the IRC effective January 1, 2021, like they always do, but they did decouple. They didn't follow federal treatment for a number of provisions that Congress had provided relief for businesses in 2020 in the CARES Act and in the Annual Appropriations Act last year. And so those include Florida is not going to be allowing the additional 20% temporary benefit for business interest expense under Section 163J. So in Florida, you're still going to be limited to 30%. Florida did not adopt the qualified improvement property or the retail glitch fix that was contained in the CARES Act. So that's an issue where certain qualified retail property, it was actually a typo in the TCJA that ultimately determined that that property was going to be 39-year property. After going around, Congress finally fixed it in the CARES Act, I believe, and said that no, that was shorter year property and subject to bonus. But ultimately, Florida determined that that was going to be a little too expensive if we had the same treatment in Florida. So now that retail property is going to be continue to be treated as 39-year property in Florida, which is interesting. Florida did not adopt the additional 50% deduction for meals, and then also Florida specifically did not adopt the changes in the CARES Act related to film and theater productions. I will note, while not included on this slide, Florida did ultimately, while not officially in any bill, they did adopt the federal treatment for the PPP loans, both on the expense and the profit side. If anyone needs any additional information, they kind of buried it in a staff analysis deep down. So if anybody runs into that issue in the future and needs help, please feel free to reach out and I can point you to where that is. But ultimately, the legislature and the Department of Revenue agree that PPP loans aren't subject to the Florida corporate income tax, which is great. Going to run through a couple other bills. Yeah, I don't have much time left. Just note, there was a bill that, if anybody's familiar with kind of new technology, things like Turo, where you can lease your own vehicle to let other people use it, that's now going to be subject to a similar rental car surcharge as other rental car companies in Florida. It's a $1 if it's less than 24 hours, but just be aware of that. Property tax bill that makes it easier for elderly individuals, seniors to roll those property tax benefits over year to year. They don't have to reapply each year. They can just apply the one time and then they get the postcard like most everybody else gets for homestead. And as long as nothing changed, that will continue to go forward. That was a good change. I'll talk about that one later. There is going to be a new constitutional amendment. Just note on the general election ballot in 2022. If you recall, about 10 years ago, Florida added to the Constitution an exemption for property tax for the value of anything you spend on your home to increase resiliency to wind damage and things like that. That was after Hurricane Andrew. That was a big push for that. Now that we're seeing sea level issues in Florida, this is a push to say that if you voluntarily raise your building or your home, actually it's just homes. So if you raise your home, then that additional value won't be considered in your property tax assessments. Let's get that one. And the last one I'll touch on is the unclaimed property bill. This is House Bill 25. It makes a number of changes to this, but I thought it would be specifically important to talk about with the section members, because the first provision in that bill, what it says is it says that if you have a safety deposit box that contains a will, a trust document, a codicil, and that safety deposit box is turned over to the Department of Financial Services as unclaimed property. The new law specifically says that if anyone goes to the Department of Financial Services and provides proof of death of the seller, then that person that provided proof can get access to those documents. So be aware of that. Advise your clients. If you have concerns with that, tell them that storing their wills and trust documents in a safety deposit box may not be the best idea. Tell them they can store it at your office. But all that being, if you're comfortable with that. But that, I will wrap up to make sure that we have plenty of time for the next speaker. Thank you very much.
So the next speaker, Joe Schimmel, I know him for over 25, well, about 25 years, I would say. We've been friends for a long time. I was just thinking that our youngest daughters, which I have one, but he has three, are just starting college. And so they were probably here, I think, at the same time at Amelia as babies, and have gone to maybe 15 or 20 of these things, who knows how many. Joe, we're getting into our heavy hitters now to like clean up the end of this program. So Joe is a partner with Cohen Chase, located in Miami. I think we took the board certification exam in tax at the same time, so he is also certified in tax, which I guess is the good news that I am also certified. He is a fellow of the American College of Tax Counsel and a past chair of the tax section. Welcome up my friend Joe Schimmel.
I'm going to try to walk around with the mic because I'm freezing. the ACTC created a challenge even bigger for the IRS than the EIPs. Unlike the EIPs, there will be for some taxpayers a requirement to refund an excess or to return to the IRS an excess ACTC. The ACTC is payable only to taxpayers that filed a 2020 tax return, but again, it's receivable by people who weren't required to file a 2020 tax return. The IRS had to issue procedures so that people could get online if they didn't have to file a tax return and still get the ACTC. June 14th, the IRS unveiled an online tool to help low-income taxpayers register for the ACTC, but they rushed this. They're adding features to it almost every day. I included in the materials examples of some of the newest IRS announcements and news releases on the advanced CTC, but since I submitted my materials on Monday, they already had 2 or 3 added to them, so it's definitely incomplete. So that's it for the individual tax update. Now, one of my favorite topics, Fred in the back, I know he loves this topic because we talked about it a couple years ago. What is a tax expenditure? Why do we have them? And I'll point out the tax section has taken an interest in tax policy for decades.
Yeah, you're like, it is.
Former
You're
tax
like, come on,
section
we gotta
chair
live,
Robert
we're
Panoff,
vaccinated,
Bob,
we do what we
shared
can.
with me and some others an interview he did in the tax section bulletin in 1980.
Yeah, that's it, so.
This is also in your materials.
Oh,
He did an
boy.
interview with Dan
Well,
Halperin, the
okay, so
Deputy
you'll do
Assistant
that,
Secretary
and
for
then we'll
Tax
just go from
Policy.
there.
And it took me a while to figure this out.
Yeah.
Where it says the
okay,
question was
that's
asked
great,
by
and,
Ed.
we'll just keep going.
That's not Ed,
And
that's
then
the editor,
Tuesday,
that
though,
was
you're,
Bob.
you're working
So-
Tuesday. I just want to make sure.
Says
'cause I gotta
Bob,
do Jordan
or
and the checks. Okay, so Tuesday you'll be in. Okay. All right, that sounds good. Have a very nice holiday weekend, because this ends at 12:30, supposedly, this thing. So after that, yeah, I'm gonna head.
But only in the last 50 or so years have they become well-known and well understood. You'll see if you read through Bob's article, a tax expenditure can be evaluated by asking 2 questions. Is the particular policy effort sensible? And what administrative problems or advantages there are in doing those policies through the taxing statutes? I also have in the materials a short article from the Center on Budget and Policy Priorities, the CBPP, describing federal tax expenditures. And I also gave you a couple tables that show the tax expenditures that we have in the 2021 year. So that's what tax expenditures are. Now, is the tax code racist? Are tax expenditures racist? I'm not going to answer the question. I'm just giving you some information. You may have heard that the tax code is racist. It sounds kind of extreme. We're tax attorneys. We read it. We go, I don't see the racist provisions in here. But there are books like The Whiteness of Wealth, appropriately, a white dust cover, that give some arguments in favor of the idea that it's racist. So I don't know if it's racist, but as a general matter, deductions, income tax deductions, they disproportionately benefit people in higher income tax brackets. Non-refundable credits benefit people non-refundable credits benefit people who owe income tax. They don't benefit people who don't owe any income tax. Refundable credits generally benefit everyone equally. I also gave you a couple reports from the CBPP on federal tax expenditures and how they see the effect of those expenditures on racial equity. So let's talk, I want to give a few examples. The first one actually, it's not technically a tax expenditure. It was not originally racist. It was originally sexist, but it moved from sexist to racist. The marriage penalty. And I don't think I ever knew this, so probably a lot of you didn't either. The 1930 Supreme Court case of Lucas v. Earl. If you've recently got your LLM or you recently taught any business entities or just regular income tax, you'll remember Lucas v. Earl. We were told it was an assignment of income case. Earl was an attorney, and back in 1920, there was only one kind of filing status, taxpayer. No head of household, no married this, married that. If you had income and you were over the very high income limits, you filed a return, you paid the tax. There were tax brackets. Earl, his wife, like virtually all wives of men who were subject to the income tax in 1920, didn't work. She did not receive compensation for services. I'm not saying that she didn't work, okay? But she didn't have an income that she had to report. So Earl and Mrs. Earl, they entered into an agreement to treat his income as being owned by the two of them as joint tenants with rights of survivorship. And then they each reported half of Earl's law firm income, taking advantage of the lower tax brackets. And the Supreme Court says this was an illegal assignment of income. But around the same time, a couple from Washington State, the Seaborns, they had a similar idea, which the obvious idea is, let's take husband's income and divide it in two. But Washington was and is a community property state. So in a community property state, both spouses equally own as marital property all of the income of the community, it's called. So they each filed separate tax returns, and they reported half of husband's income. The IRS audited, and there was no tax court yet. So Mr. Seaborn paid the tax, sued for a refund, took it to the Supreme Court, and only 8 months after Lucas v. Earl said no assignment of income is allowed, Seaborn won. Well, that set off an avalanche of other states saying, we've got to get this community property. This is fantastic. Our residents can pay less tax if we have a community property regime. Well, the first ones, like Oklahoma, said, I mean, it sounds great, but the problem with community property is the wife actually owns some of the income. And that's not really what we're about here. So they made it optional. If husband and wife jointly decide they want to be community property, that's cool, but we're not going to force people into it. And the Supreme Court in 1944 said the opt-in community property is not a true community property regime, and they disallowed community property tax reporting in opt-in states. That case was Harmon. I'll let others figure out whether the Florida Community Property Trust Act is opt-in and whether it violates the Constitution or violates that Supreme Court case. But in any event, there was, in many states, a lot of resistance to this community property idea of letting women share in the husband's income, which was, let's face it, 98% of the time, made that number up. So in the Revenue Act of 1948, Congress enacted, over President Truman's veto, interestingly, the Revenue Act approving joint returns for spouses, and immediately states started repealing their community property laws because now we didn't have to do that anymore. So prior to the TCJA, dual income spouses frequently encountered a marriage penalty. That marriage penalty was more likely to affect Black married couples than whites, as Black married couples are more likely to be dual earners with equal income. Now, after the TCJA, many spouses get a marriage bonus, and of course that marriage bonus disproportionately benefits whites. So now let's talk about individual tax expenditures and are they racist? And I realize I should have made this tax expenditure bingo. So in B1, employer-sponsored medical insurance is the biggest tax expenditure, individual income tax expenditure. The exclusion of employer contributions for medical insurance premiums and medical care. What percentage of Americans are covered by employer-provided insurance? Total, 58.8%. Whites, 65.8%, almost 10% higher than the average. Blacks and Latinos, way below 50%. Not racist. Even in firms that employ 500 or more employees, you would figure Firms that have 500 or more employees, these are big firms. They're not going to be like discriminating intentionally. But even in such firms, Black Americans are 10% less likely to have employer-sponsored health coverage. Number 2, and 7, and 11, home ownership tax expenditures. Well, we've all heard that institutional racism has over the decades made it more difficult for Black Americans to accumulate wealth, including purchasing homes. So it won't surprise you to know that these three tax expenditures, the three tax expenditures are excluding net imputed rental income, which Fred tells me he doesn't think should count, deductibility of mortgage interest on owner-occupied homes, and the exclusion of capital gains on home sales under 121. So these three tax expenditures disproportionately benefit whites. What percentage of Americans own their own homes? 64.5% of all Americans, families own their own homes. Whites, 73%. Blacks and Latinos, under 50%. It's not racist, just works out that way. Employer-sponsored retirement plans, that's B3 and B4, DC plans and DB plans. Participation higher for white Americans than Black Americans, even within the same employer. But this is true for opt-in plans. For opt-out plans, under ERISA, employers are allowed to say everybody's a participant as long as they're over they're not part-time, they're full-time. Everyone has to participate unless they opt out, right? Lowell, am I right? In opt-out plans, Black and white participation is equal. So, I don't know if there's racism, but the Biden plan, arguably, is going to use the tax code to help reverse some of the racist effects of the tax code. I've given you parts of the 2022 Green Book. The Biden administration would like to continue many of the programs that were contained in the American Rescue Plan Act. He would make permanent the expansion of the premium tax credits, the expansion of the childless EITC, changes to the child independent care tax credits, and extend the child tax credit increase and the ACTC through 2025, make child tax credit refundability permanent, and increase the employer-provided child care tax credit for businesses. So, what's the benefit of all these, what I will call welfare provisions? Just the ACTC this year is expected to reduce the number of children living in poverty in this country from 13.7% to 11.3%. That's about a quarter. And the other parts, that and the other parts of the American Rescue Plan Act are expected to drop child poverty during this year to about half of what it was at the beginning of the year. It's taking half of the kids in this country who are living in poverty and lifting them out. So would these policies reverse the racist effect of the tax code? Oh, I don't know. I'm just telling you facts. I did ask myself, and I'll ask you, if you'll think about what the two requirements are for when we should have a tax expenditure. One is there a good policy effect? And two is, should the IRS be doing it, or should this be some other kind of welfare program? So I said, well, it's hard to judge. It's hard for me to tell you what's good and what's bad. But we can ask, is the IRS efficient at delivering benefits? What's the administrative overhead? Okay, so I got an extra 2 minutes though from French. I see you over there. So I think we all know the administration wants to increase the IRS's budget by $80 billion over the next 10 years. And the cost of the programs that the president wants to extend are estimated to cost $822 billion over the next 10 years. So if the entire $80 billion of IRS increase was merely to provide these welfare benefits, that's 10%, that's pretty expensive. But that's not what the $80 billion is going towards. The IRS pushed out 3 EIPs, they pushed out the ACTC, they implemented all this other new legislation, and the increase in budget from 2020, from last year to this year, only $300 million total. So if that entire $300 million was the cost to implement, that's my warning to myself, To implement the EIPs and the ACTC, that's an overhead of less than 1%. What do other government benefit programs cost? Since I'm getting near the end, I'll just give you, I looked these up. Social Security Administration, the cost of administering SSI is about 7.5% of the benefits paid as overhead. HHS, Medicaid, Head Start, TANF, other government programs, the welfare programs, not Medicare, the welfare program, $726 billion a year, and states and the federal government spend 5% of Medicaid funds on overhead, 10% of TANF, or that's food stamp funds on overhead. HUD, and by the way, these expenditures are proposed for 2022. HUD would spend about $70 billion next year on housing. All of what HUD spends on housing is welfare related. Their overhead's about 3%. And Department of Education would significantly increase spending for K through 12 infrastructure, educating the disadvantaged, free community college education. Department of Education's total budget is $103 billion, and their overhead's about 2.5%. So compared to that, the cost of paying welfare out through the IRS, I think, works out pretty low. Thank you.
Thank you, Joe. We're going to take a quick, very quick 5-minute break for people that need to get their mimosas. Oh, wait, I have mine. Right? Right before we're going to start, and then we're going to start up with ethics tax bingo, the hottest game in town. So let's take that break and come back in right away. We're going to start right sharp in 5 minutes.
No, I mean, you don't usually just.
You want to just get on?
Yeah, that's fine. No, it's fine.
Save the time?
No, it's not even saving the time. You just don't need to.
It's fun.
Huh?
I said it's fun.
What, are you going to read the whole thing? No, forget it. I don't care. It's in there. If I close this, is it going to mess everything up?
I would ask. I don't know. Charlotte. Who is? Charlotte. Try to funnel them back.
Who else needs a bingo card? Okay, we're gonna get started. Listen up, everybody's supposed to have a bingo card. That's one. Number two.
You gotta do it from the mic.
We have really cool shirts on. So everybody take a look at Harris's shirt. I like to use my bingo voice. What's yours say?
A lot.
It's all fun and games until somebody yells. Bingo! That's it. And wait till you see Sean, if you haven't seen it, it is just so Sean. Second, the prizes, and I don't drink. You have your choice of Jamaican rum, your choice of Jamaican rum, your choice of Jamaican rum, and I really mixed it up this year, or 2 6-packs of beer, but of course it's Red Stripe, which is a Jamaican beer. Now, Sheridan's running around, she's got the caller card, because I'm not gonna sit here when you all decide who's winning and who's not winning, because I ain't getting in the middle of it, okay? The decision, not me, of the people with these shirts on, they'll decide, or just let Sheridan decide, okay? Now, this is where everybody gets all confused, and I'm really sorry for the people who are on the video, if they should just come next year. And that is, the first bingo is a regular bingo. Right? That means straight line, X or a cross, and there is a free space. That's Harris. You see Harris, no name in the middle there? That's the free space. We were going to put his picture there, but I was too cheap to pay extra for a different program. You know, that's it. Basically, we're going to have to do it. The second bingo is an X. Got it? An X. An X. Right? The third bingo is a box. That means around the edges. The fourth bingo bingo is filling in the entire card, and that does not mean when Karen's kid just draws pretty pictures in all the boxes, or like this kid. So anyway, has everybody got those rules? Okay, everybody should have some materials. What? I don't know, it doesn't matter. So anyway, this is gonna be indescribable, but my question to everybody is, if this is indescribable, isn't that a description? And the crowd goes totally silent. Okay, let's get started. First of all, 90 days, 91 days. For those of you who look at ethics cases at all, and I do, you will notice, particularly in Florida, that two things are happening right now trend-wise. Trend number one is that the Florida Supreme Court is making longer penalties and discipline on attorneys. And in fact, I am finding that they're more regularly doing something different than what the settlement was or worked out with Bar Counsel, which I find kind of interesting and a little scary for those people who are getting hit with discipline. But when you look in there, the general public doesn't realize something, and I've mentioned this before. There is a massive difference between a 90-day penalty and a 91-day penalty. It is not 1 day, because if you're suspended for 90 days, on that 91st day, you've got your ticket back. On the other hand, if you're suspended for 91 days or more, guess what? You've got to show that you're a better person. That's not how it's worded, but for Ullman, you're in review. That's a summary enough. So clue number one, big difference between 90-day and 91-day suspension. Big difference between a 90-day and a 91-day suspension. Second, the discipline system in Florida is public. Therefore, clue number two, discipline sanctions are part of the attorney's public record. By the way, the only exception in the statute is if you were disciplined because you had a felony conviction and the felony conviction was overturned. That's the only exception in the rules. Third thing, 10 years of discipline history are listed on the Florida Bar's website. That's your third clue. 10 years of discipline history are listed on the Bar's website. And by the way, if you're suspended for 5 years or more, you got to go take the bar exam all over again, which is probably an invitation to retire at that point. Okay. I put in your materials an awesome article by Brian Berglund, where it goes through in detail the discipline system in Florida. He really did a good job, and it's included as an exhibit. Next thing, how many of you here, I can't do this for the people that are virtual, but how many of you that are here have designated an inventory attorney? I had guessed it would be about half, and it's a little more than half here, which is kind of neat. We're all required to have an inventory attorney. So your clue is, I want to make sure I word it right, all Florida attorneys must designate an inventory attorney. And that's if you get suspended, disbarred, die, have medical issues, or otherwise. It's a person who's supposed to come in and try to keep things moving along. What happens in a lot of situations is Bar Counsel ends up having to go to court to get somebody appointed, because even if you designate an inventory attorney, guess what? They don't always choose to do it. Next thing, increasingly, DC is probably at the forefront of this, but there was a good-sized Florida law firm that is trying to create these pseudo partnerships where they give them the ability to attend and participate in partners meetings. They can take bonus compensation. They just don't get the vote. So the clue is Florida Bar may allow partnerships with non-lawyers. You're going to see more and more of that as a trend, and that is your clue. DC is probably the most liberal one in that area. I suspect by now everyone here has found out that the ABA credits are no longer allowed to be used in Florida. Okay. And what happened here is good intentions didn't work out, but the Florida Bar Business Law section put basically diversity quotas as a requirement. The idea was to just have more diversity, which I think everybody would be in agreement with. Problem is, Florida Supreme Court said that that was discriminatory. And then they came out and basically said what? They came out and said, therefore, you can't get credit for this stuff. Well, the ABA has a very similar policy. So it's been a real problem. I don't know how it's going to get resolved. And you'll see in the materials, I gave you kind of the wording right out of the, both what the business law section had and what the ABA section. So your clue is, going forward, ABA programs no longer qualify for Florida's CLE credit. Going forward, ABA programs no longer qualify for Florida's CLE credit. All right, technology. Number one, phishing. Clue, careful with phishing. I mention that because I know, how many of you in the larger firms or in any of your firms actually have your IT department testing you? They'll send out something and hope. I see a whole bunch of hands are going up right now. Red Cross, some of you know I'm fairly active with the Red Cross, and every year they seem to be doing an update on that. And part of it is they'll give you, is this phishing, is this not? So you really need to be careful. They're getting good. They're getting more sophisticated. They're coming in with faxes and stuff. But the next one, and I gave you copies of this, and when I got it, I wasn't sure if it was accurate because I had a company that did my website for my firm, and we're not using them anymore, but my staff's been keeping it updated. And it said that I'm violating a copyright. I'm thinking, that sounds like me. So nobody laughed at that either. But anyway, so I'm looking at this, but then within a day or so, I get another one that's almost the same, a little stilted language. And then a couple of days later, I get another one. I've gotten a few more since then. So, and by the way, it's for every area of practice of law. They just sort of changed some of the words around. So the new phishing, this is a clue, new phishing, copyright violation notice. I just found that was entertaining. New phishing, copyright violation notice as a clue. Next thing, this could be a whole program, but it's a clue. Best practices for remote court proceedings. The bar came out with something and it's really good, and I gave it to you. If you are doing remote proceedings or you end up having to do one, you really want to read what I put in your materials. Now, you go, why? It's not a rule. It's just some good ideas. I'm pretty good at this. Palm Beach County Bar Association, which is a voluntary bar association, years ago came up with basically these rules of professional courtesy. And it was signed off by the court, by the chief judge. And I have seen people now, because it's not a rule, but if an opposing counsel does something that you don't like, part of your motion for protective order is it violates those rules. It's basically suggestions of professional courtesy. Same idea here. I think that if you're going to start doing things that are going to be violating this, it'll start becoming a course of conduct. Social media guide. This is another one. You could spend a whole program just on this. I put it in there. It's talking about all kinds of things, how you can respond to negative website posts and things like that, which is kind of saying don't say much of anything. But it goes through a whole lot of things because a lot of the traditional advertising rules that we all knew about with this online stuff and the posts and the blogs and reposts, it's tough. So the clue there is social media pocket guide. Next one. This came out of an exempt org, but it kind of applies across the board, but it was kind of fascinating. So I put it in here. And the clue is attorney-client privilege, careful with third-party emails. This one was kind of interesting because, and I've just got to read this. This was an exempt org, but directors and employees of a parent company used email addresses belonging to a related third party, a majority-owned subsidiary in which the individuals had overlapping roles, to discuss the legal affairs of the parent with attorneys. This happens all the time, doesn't it? The court found that these communications were not protected by the attorney-client privilege. This is a state court case, but the concept is really scary because we're always layering things. And again, this is probably a real good one for some litigator from some other section to come in here and do a program on because it's scary, which leads to the next clue. Cyber hygiene is important. Cyber hygiene is important. And that's part of what the court was talking about here. And it was interesting because the person who wrote this blog, who I know, She's a really good nationally known exempt org attorney. She thinks to encourage the use of personal emails for exempt org business. In other words, rather than using these affiliates, just use your personal email, which was kind of interesting. And, but anyway, so it's in there. Next thing, we all know this. There was actually somebody who went on Shark Tank with this little plastic thing. Cover your webcam when not in use. That's a clue. Cover your webcam when not in use. Just do it. Just do it. You don't have to buy anything. Although I think in our bags, we got things that'll fit right up there. I take a sticky note and fold it and stick it over there. And eventually it falls off, but it doesn't matter. All right, Alexa, this is a clue. Alexa is always listening. And by the way, did you ever have Alexa just chime into a conversation when you're in the kitchen? Yeah, so for those of you who have Alexa in your office, which for many people in this room last year especially, you were home in your office, Alexa's always listening. That's a clue. Unplug it. It's bad, but be careful. IRS, the service, all kinds of electronic filing of forms. What's interesting is a lot of these additional electronic filings, including the acceptance of facsimile signatures, photocopy signatures, and treating those as wet signatures, it ends at the end of this year. It's going to be interesting to see what they keep on and what they don't keep on. But it's floating around out there. Next thing. Many of us are picking up virtual clients. By virtual clients, I mean ones who don't physically step foot in your office ever. Some people were doing that before. Now, I've mentioned in some of my prior presentations how critical it is to make sure that your client, you know who the client is and get ID. Because once you start, I do a ton of tax controversy work. Once I represent the Department of Revenue or to the Internal Revenue Service or something similar that I represent this person, I better represent that person, meaning I know who that person is. So I get ID before I will submit a power of attorney or do things like that external. Problem when you're doing virtual is, oh yeah, they'll upload or fax you or email you their driver's license, but I don't know where they found that driver's license. So sometimes you're going to need to increasingly visualize that you can see the people on a Zoom or whatever system you use so that it actually matches their ID. So your clue is careful to ID virtual clients. Careful to ID virtual clients. And those of us who do controversy work, we've already run into cases where what? The spouse says, I didn't sign. The other spouse went online and did it. I think it's going to be worse now. We're going to be seeing these cases in 2 years and 3 years and so on. Next one, notaries. How many of you actually notarize things for clients? About half the room, a little more. When I first started practicing a million years ago, the law firm didn't want the attorneys to notarize things. They just wanted support staff. The attorneys that were doing trust and estates and tax stuff, we said, it just doesn't work. The reality is, even if your firm has a policy like that, you're still supervising the support staff. And it's very easy to ignore a lot of the notary rules. So I just want to remind you of a few. First of all, and this is a clue, don't notarize a transaction if you have financial interest in the transaction. That kind of goes without saying, but don't notarize if you have a financial interest in the transaction. Second, when you notarize, and this is a problem, you need to make it clear whether or not you know the person or if you ID them, what ID you used. And one of the things that the Florida Secretary of State complains about is people will go, like, they'll put NK something and DL. And you're supposed to go known to driver's license. They don't like that. So what you really want to do is be clear. So your clue on here is notarize. If client or person you're doing is known, or put the ID type. But you've got to be really clear on your notarization. So be careful with that. Next one, and this is kind of interesting because it'll zoom over to the tax side. Many people in this room do international. I don't know to what extent. Does anybody here just do immigration also? Where you're actually doing immigration paperwork? Because one of the things there is you have these resident alien cards and they need to be, you need a copy of them, an official copy. Problem is you can't get an official copy. Therefore, because of that, A notary can notarize them. So your clue is it's okay to notarize resident alien cards. Well, who said it first? And Sheridan or one of the people with the black thing will decide. Don't look at me, Harris. You're the chair. You figure it out. All right. All right, so here we go. This next point is kind of insanely, you think, stupid, but your notary seal has to be in black ink. You remember when we had the raised seal and then we had to take pencil and go across it so it would photocopy? But now they've made it clear, which I've been doing for years anyway, that you can actually have people and you can sign as a notary in blue ink, which that way you can tell what the original is without having to lick your finger and smear it. How many of you had to do that? You don't know what's the original document? So you go like this and it'll smear if it's ink. It's gross, but it works. That's not in your materials, but it's a true tip. Anyway, so here's your clue. Black seal, blue is okay to sign. That's your clue. Black seal, blue is okay to sign. Next thing, ever since Florida came out with the rule now where you have to say physical presence, we're all getting documents for clients from other states. And quite frankly, even from in-states where they just have these pre-set up notary blocks. So the question starts arising, well, can I notarize them? The block is wrong. And the answer is, of course you can notarize it. You just got to fix the block. Either put your own block in, or what I find myself doing is writing on it. Personally known to me, physical presence, so that it's crystal clear. So the clue here is meet Florida notarization rules. Meet Florida notarization rules. Sir. Yes, we're going for an X. Thank you. Thank you for that. We're going for an X now. Next one. May I sign a document if one of the witnesses, if I'm also acting as a notary? This is this classic thing you start running into when, especially you see it on deeds, where the notary is one of the witnesses. It is allowed. I think most of us agree it's not ideal, but it's acceptable. The challenge is many of the documents that we do, the notary is not simply notarizing the person who's signing, but they're also notarizing, for example, in a self-proof of will affidavit, they're also notarizing that the witnesses actually did it also, right? So it's okay for the notary to be a witness, and that's a clue. Notary can also be witness. But the next clue is notary cannot notarize their own signature. And again, notary cannot notarize own signature. You're going to go, duh, no kidding. The problem is you do it inadvertently, because if you act as a witness on a will, for example, or a trust where you're doing a self-proof affidavit, and then you do the self-proof affidavit, you just notarize your own signature and you can't do that. So be really, really careful with that. Now, what about being asked to photocopy, to notarize a copy of an income tax return? Can you do that? And the answer is no. Do not, this is a clue, do not notarize a tax return copy. Why? Because you can go to the government and get an official copy. That's the standard. You can't notarize something where they can go get an official copy. All right? So be careful with that. I gave you about a page or so of ways to go get these records. For those of you who don't do controversy work, it may be helpful. Those who do controversy work, you already know that stuff. Next thing. Clue. Careful how you protest the judge in court. So this was one in here that I just threw in because I thought it was an interesting case. Why? Because the judge didn't like how this person acted. So the penalty was a $500 fine, and they had to write, this is a judge's order, 25 times, I will not engage in conduct that is prejudicial to the administration of justice or any other conduct that will adversely affect my fitness to practice law, and I shall not engage in conduct intending to disrupt the tribunal or engage in undignified or discourteous conduct that is degrading to the tribunal. It was a criminal case.
The lawyer did not like what this guy did, the judge. He didn't like the judge's order. So what did he do? He basically staged a protest. So I just got to read this thing. This attorney told the judge he's going to sit in the back of the courtroom. The judge tells him to sit down and be quiet. So while the judge is instructing the jury, he leaves the defense table, stands behind the television stand, and he's just basically moving around the courtroom and making a spectacle, and the judge just wasn't happy. So anyway, I think the guy was convicted. It's on appeal, so we shall see. All right, next one. ABA Ethics Committee has a formal opinion on material adverse interests. We all know that a couple things. We know that we're not supposed to do conflict of interest, right? We also know that with certain procedures and disclosures, we can waive certain conflicts. Keeping in mind that under Circular 230, all conflicts are waivable, but certainly under the Florida Bar Rules, all conflicts are not. But what this opinion differentiates between are direct adverse conflicts and what they're referring to as material adverse conflicts, when you've got other information. So your clue is material adverse conflict might including attacking your own prior work. In other words, you made some kind of a technical argument in one case, you get another client who has nothing to do with this client, but you're going in court and making a different argument, going against your first argument. So that is considered to be materially adverse. That is a clue. So you need to be very, very careful with that. And I gave you some more information in there. Next clue. Material adverse conflict can exist even if it's not directly adverse. Material adverse conflict can exist even if it's not directly adverse. So be careful with that. Moving along. This was kind of interesting. I was on a Federal Bar Association tax section call. It was actually a pretty small group a few weeks ago. And with the new administration, this particular attorney was asked to come in and assist with some of the transition. So a lot of what he was responsible for was vetting people for presidential appointments and judgeships. And he finally said the following, so I put it in here. And this is a clue, you ready? Do not deduct non-cash charitable gifts if you want a presidential appointment or a judgeship. And we're all thinking, I'm sure, like, why is that? He said, and I'm not supposed to quote because it's not for attribution, but he said, they're going to do a tax check. And he said, you think you have the receipt? You don't. So anyway, I just thought that was kind of interesting. So, all right. FinCEN GTOs, geographic targeting orders. If you don't know what I'm talking about, and you in South Florida and a few other places it applies to, certain requirements have to be, basically you have to file certain information to the Financial Crimes Enforcement Network, which is FinCEN, for certain types of real estate transactions and certain other transactions. They keep extending this requirement. So I just want to let you know they've extended it again. I put it in the appendix if you know what I'm talking about. If not, you're probably not dealing with it anyway. Then they came out with it. And so GTO impacting part of Florida is extended. That's your clue. GTO impacting part of Florida is extended. Well, don't tell me, tell whoever's in charge of such things. All right, here we go. Next one. FBAR rules may change to include some virtual currency. FBAR rules may change to include some virtual currency. I know we have Charlotte doing presentation with virtual currency. It's becoming increasingly a hot topic. Even exempt orgs are looking to accept virtual currency. So I'm waiting to see if exempt orgs, we're gonna have to start filing FBARs because of where they got the virtual currency from. It's gonna be entertaining. Next thing, and this is your clue, learn the Corporate Transparency Act. For those of you who don't know what the Corporate Transparency Act is, it's in my view, a nightmare. To the extent we had any personal privacy before, this erodes it in enough of a way that it's a jingo, you pull that last piece out and it's just gonna fall down. The cool thing about it is it's not really effective when they come out with regs. So maybe it'll be like one of those reg projects where 10 years later they don't have regs, but I suspect they're gonna come out with them quicker. For those of you who are really familiar with this, I'm asking, actually what I'm really doing is begging that when they come out with the regs, somebody here or in the virtual world needs to do a presentation to teach us from a practical side what to do, because you're going to have to show ownership essentially of all these layered entities. So I know somebody was talking the other day about trying to move it. What's those things with the LLCs? You got one and another one, another one. Some states have it. What's that called? Series LLCs. It's going to be very interesting to see how it's going to impact with the Corporate Transparency Act. All right, moving right along. Next clue. Denial of passport services due to IRS certification. Your rights are not violated. Denial of passport services due to IRS certification, rights not violated. For those of you who are familiar or not familiar, there's a significant delinquent tax debt. They can yank your passport or not renew it or non-issue it. The threshold, it's 50,000, it's indexed for inflation. We're up around 54,000, something like that. So somebody challenged it and said, he's just violating my rights to international travel. Court said that's not a fundamental right. Okay. Now, it's kind of challenging to me. So the next one that I have, and it's kind of feeding off of what Joe talked about, and it's your next clue, is does passport revocation have a discriminatory impact? So I'm going to get on my soapbox. For those of you who know what soapbox are, this is just a chair, but I was going to get something that said soapbox, but I didn't. One of the challenges here is in the typical clients that a lot of us are seeing with the EITC credits and other things, some people really know that they're not doing it right. But it doesn't take a heck of a lot to get to $54,000. And a lot of the people that are getting hit, my Haitian clients and whatnot, many of them, they don't have the money. I mean, some of them come in, but significant numbers of people don't have the money to hire an attorney in the first place. And they end up owing a pile of money. And all of a sudden, they're going to lose their passport, their ability to travel, to see their family, to help their family because of some of these requirements. And I don't know, it bothers me. So I'm going to get off the chair and move on. All right, here we go. The current OPR director is Sharon Fisk. I had a chance to talk to her pre-pandemic because I sat down at a table in a meeting and she sat down next to me, so that was cool. And she seems pretty good, which is nice. For those of you who have not heard, and that's a clue, by the way, current OPR director, Sharon M. Fisk. Next one, acting director, this is a clue, acting director, Office of Promoter Investigation, Lois E. Dietrich. If you have not heard of the Office of Promoter Investigations, you will likely, and it gets confusing because they're calling it OPI. They are working with CI, that's criminal. They're working with civil, they're working with LBNI, which is large business, international, and they are going after promoters. And they're doing it in a way using more electronic, intelligent computer things, whatever that stuff is called. And you're going to hear more and more about it, so at least now you know it exists, but that is a clue. OPR structure, I don't have time to talk about it, but I gave you a current organizational chart. Next thing, I want to remind everybody, and this is a clue, OPR is Title 31, not 26. So you can get hit with an Office of Professional Responsibility penalty under Title 31, still get hit criminally, and still get hit civilly, including under Title 26. All right, and I'm not even going to hit all the client conspiracy and all that other stuff you can get hit with. But you got Title 26, you got criminal, and you got Title 31, which is OPR, and that's a clue. OPR is Title 31, criminal and civil are separate. Now, we all know about due diligence. Even as practitioners, there's due diligence, whether we're signing a return or doing a meaningful part of a return, and then talking about what's practicing before the Internal Revenue Service. But what I'm seeing a trend towards is the service looking even more to practitioners. They have those checklists you have to do for EITC and whatnot. But what I'm seeing is this trend, and it's scary a little bit, where they don't have enough resources, so they're looking to practitioners. So here's some areas that I think you're going to see more of where the services are going to expect more due diligence from practitioners. One is reasonable compensation as due diligence item, and that's a clue. Reasonable compensation as due diligence item. Now imagine this, you're doing a tax return or you're handling a controversy matter for somebody and they've been treating it a certain way. What do you do the next year? Or how do you fix it? Do you then have to go and do the 940s and 941s over again and create a nightmare? So I don't know, it's going to be an issue. Second, and this is a clue, in my view, the Internal Revenue Service is looking for preparers to fix the problem. All right, and it's a challenge because they don't have enough resources and they're not going to have enough resources even with the budget increase. Next issue, and this is a clue, employment tax issues as an income tax due diligence issue. These issues about whether or not somebody's an employee or not, how they're treating, even people that are otherwise self-employed and they have business entities and things like that. Next thing, and we're seeing it already, and that's Schedule C diligence requirements. I see it a lot with some of the EITC and refundable credits where people just make up Schedule C income so that they can then take a deduction, which begs the question, what a lousy way to try to create minimum income, but that's a dirty word for many people. So we're trying to do it through the tax code and it's not working very well. It really isn't. Next thing, prepare penalties during an audit. For those of you who do controversy, how many of you have ever seen or had cases come in where the revenue agent is making noises about prepare penalties during the audit? Okay, because I know I have. And these aren't returns I did, so it wasn't like it really impacted me. But what they start doing is trying to create daylight between the taxpayer and their preparer, right? Because they go to the taxpayer, well, you go in here and I won't hit you a penalty and they'll just go after the preparer. So what's happening right now, okay, is number one, auditors are not to disclose preparer penalty decisions. This is a clue. Auditors are not to disclose preparer penalty decisions to the preparer or the taxpayer during the exam. But the next piece is interesting, which is, and this is a clue, preparer penalties are to be considered on all examinations. Now, the reality is it may be considered and you move on because there's no appropriateness for it. But it's a thing that they're supposed to consider it on all examinations. Now, we then go, well, I don't prepare tax returns. Well, some of us will do 706s perhaps, but I don't do tax returns. But remember where these things apply to. I'll give you a couple examples and they're clues. Otherwise, it's on page 15 of your materials. Installment agreement request is practiced before the IRS. Installment agreement request is practiced before the IRS. Next one, a penalty abatement request is practiced before the IRS. A penalty abatement request is practiced for the IRS. And one thing that was clear, and I got that from my little sitting there next to the head of OPR, for penalties, patterns matter. Sure, sometimes a bad act is enough on its own, but if you look at a lot of the discipline cases coming out of OPR, it's the pattern that they're looking for. Now, I'm finding that on prepare penalty cases that aren't OPR type cases, you start to wonder to what extent the patterns really matter, but clearly on a lot of these patterns matter. All right, next one. FOIA, this is short and sweet. For those of you who do FOIA requests, FOIA, well, they'll handle it internally, the IRS, but sometimes they need to get records from other agencies or you do a request to another agency and they have to go to the service to get the records. And it used to be whoever got that request would just deal with it. Now it's more trying to be more centralized because what they were finding is there were some inadvertent disclosures. So they were trying to reduce things. So your clue is there's more procedures for IRS FOIA involving non-IRS agencies. Next thing. Form SS4 responsible party. In your materials, I gave you copies of the SS4 from 2019, one from 2017, and one from, I think it was 1998. Why? Because the forms look pretty much the same, except for this nasty little box about responsible party. And I think it's this underused thing. And I haven't run into it yet, but if you read what the service is asking for, what the heck does a responsible party mean? Oh, they define it, and I talked about it in the materials here. But are we going to see responsible party being used in non-tax litigation, that they're the responsible party? Are we going to see that used as a factor for assessing trust fund penalties? I don't know the answer to that question, and I haven't seen an article about it, people talking about it, or anything like that. But this is a clue. You must disclose the name and ITIN on the SS4. That's a clue. You have to disclose the name and ITIN on the SS4. But whose name and ITIN are you doing? It's a responsible party, and it can't be an entity. So even if you're layering entities, you got to pick one. If you got several, you got to pick one. And people aren't talking about it. Second, how many of you have ever in your life filed an 8822B? One person, two people. Okay. How many of you handle assets, business sales, where you're selling the stock of a business, maybe a closely held business, right? And you put in there, and we all know maybe they're going to make the election to treat it as an asset purchase, and you do the allocations and all that, right? We all know to do that and remind the accountant, right? But if you need to, and this is a clue, report a change of responsible party on Form 8822B. Because if you go ahead and sell the business and you're still listed as a responsible party, oh yeah, they went to the Secretary of State and they changed it and they have a new person listed on the tax return and all that. But apparently that doesn't automatically change who you have on the SS4 as a responsible party. I don't know what it means, but nobody's talking about it. Well, I am now, and I think I'm gonna talk about it some more. But anyway, so next thing, nominees, this is a clue. Nominees cannot obtain EINs. Yeah, nominees, we do it all the time. We form an LLC and all that kind of stuff. Now, here's the interesting one. I don't even know how we figure it out, short of doing a FOIA, because half the clients don't have any idea who did it. Well, my accountant did it 20 years ago. If a nominee was used, and by the way, this may affect that Corporate Transaction Transparency Act, but this is a clue. If a nominee was used for an EIN, you need to fix it with that 8822B form. And I gave you addresses and materials, and I gave you copies of these things. So query, this is a clue. Query, is the SS4 responsible party a factor for trust fund, et cetera, liabilities? And I don't know the answer to that question, but it's going to be an interesting one. I mean, it ranks right up there. I think it's even less blatant than the little box in Schedule B if you have one that says you didn't have a foreign account, but you also aren't wearing your glasses that day, and it's a tiny little box. All right. Zooming right along. Pentagon Papers. 50 years ago. 50 years ago, we had the Pentagon Papers. And now what do we have? Now we have billionaires with their tax records, right? Well, there's the clue. Potential criminal liability for improper disclosure of return information. Next clue, because I know we're out of time here. So, can the government keep a secret? We have these expansions of all those requirements, although I was talking about before, for example, with FinCEN, right? I'd get back up on the chair here as my soapbox. They want to strengthen or have more disclosure. How did this records get out? I have no idea. Next thing, DSU. You all know about DSU, right? The deceased spouse unused exemption. For the smaller estates, where the $2 million, $3 million estates, and you're doing an administration, if you're not putting at least in a piece of correspondence to the client about something about 2 or 3 sentences on DSU, did you have this ability, you're not doing it, there's a time frame, that'll be the client that 3 years later either wins the lottery or somebody rich dies and leaves them, and then they're all mad at you. So next clue, do a CYA for DSU. Next thing.
You gotta call it.
Yeah, you got to call it if you got bingo. All right, just we have a few more. I have 1, 2, 3 more clues. Okay, 4 more clues. Townsend plan. There was a whole piece on and you can read it in here, talking about sales tax tokens and things like that. It was a minimum income plan, this Townsend plan, but it's a clue, so I want to mention it. Townsend plan was designed to provide minimum income to the elderly, paid for basically with a 2% national tax. It would have been like a VAT. The whole point of sales tax tokens, and it's interesting, we talked about that with the state and local piece here on the SALT side, because of the minimum income. I mean, the minimum, how you round. What was happening is back then a penny meant something 50, 60, 70 years ago. So if you kept not getting that half a penalty or 2/10 of a penny credit, so they came up with these things called sales tax tokens, either put out by the government or privately, so you got credit. So if you paid a whole penny, they'd punch it until you used up the whole penny of credit. So the second one, sales tax tokens were, it's a clue. Sales tax tokens were created to prevent a consumer from overpayment. That is a clue. Two more, income tax. This was just an interesting case. You had a divorce case. Person gets divorced. They then hire a lawyer to sue the first lawyer for malpractice. They actually won and then paid their lawyer. But what's interesting, for those of you who do taxation of litigation, is the person tried to then deduct the attorney's fees and all, and they're like, wait a minute, this was not return of capital. This was because of the malpractice. And you didn't plead it that way and you didn't settle it that way. So my comment is, don't commit malpractice when helping with a malpractice case. That is a clue. And the final clue, which I just want to read, and this was a judge, federal judge in the Northern District of Georgia. She said, be kind to one another in this most stressful of times. Remember to maintain your perspective about legal disputes, given the larger life challenges now besetting our communities and world. Good luck to one and all. So your final clue is, in this most stressful of time, be kind. Thank you. Yeah.
Yeah. I think we get some extra ethics credits there. Thank you, Michael. That's the end of the Ullman year in review. Thank you all for being here, and go out and enjoy the beach, and maybe the mimosa bar is still open. Good to see you all today. Thank you for being here.